this is the second academic session of the conference, and it's going to be about more or less firm heterogeneity. So we're going to have a very nice paper about production network, a second paper about firm access to finance, and a third paper about product entry and inflation. Firm entry and inflation, I don't know if it's objective in the model. So I think we're going to start with Jose. Jose, you have 20 minutes. You can be here or here, depending on what you prefer. Okay, the floor is yours.
Thank you. Okay, so thank you, Alex, for the nice introduction, and thank you, everyone, for joining and for including our work in this very nice conference. So this project that I'm going to present today started initially as a policy question, really. It started, we wanted to understand, I joined the Bank of Spain in 2022. We wanted to understand the inflationary effects after the Russian invasion of Ukraine, how that affected energy and food prices. And our managers wanted to understand the transmission, really, through input-output linkages, how this transmit to core inflation or to other more indirect effects through wage increases. And this is basically our answer to their demand. As a motivation of the paper, there has been a recent wave of supply-side macro perturbations with very granular and international origins. So we've been presenting this paper for 2 years now, and we keep adding bullets to that list. So we think it is an important framework to understand the recent episodes in the economy. So we can use it to interpret energy price increases, supply bottlenecks, COVID-19, or the recent trade war that we've witnessed. So something that we want to say is that despite these shocks that I highlight there are very different in nature, they share a key characteristic, which is that even they originate in very specific and different sectors, they quickly spread through these production networks and international supply chains. So we want to understand here how these shocks are transmitted through input-output linkages and how do they spill over to countries and sectors. So in this paper, we want to, again, investigate this transmission with a particular focus on inflation dynamics, motivated by the increase in energy prices that we're witnessing now, but that we also witnessed 4 years ago. And we're going to build a model that is going to accommodate, it's going to be a global economy with multiple countries. We will have some results on country heterogeneity. We're going to allow for, within each country, there's going to be a multi-sectoral productive structure with both national and international linkages. And we're going to assume that sectors at the country level are going to be subject to nominal price and wage rigidities. And then, if I have time, I'm going to discuss about how production networks reshape the monetary policy trade-off, which is the title of this conference. And we're going to calibrate the model to the main euro area countries and their trade partners. So in terms of our findings, in case I don't get to present one of them or some of them, we're going to focus on these effects of the imported energy price shocks in the euro area. And we're going to have 4 main results. First of all, we're going to have, under some restricting assumptions, we're going to derive some analytical results. And we're going to argue that the international networks are going to steepen the Phillips curve, and that sectoral terms of trade caps are going to prevent the divine coincidence that closed economy models with production networks deliver. We're going to highlight the quantitative contribution of input-output linkages. We're going to show that without input-output linkages, the effect of an energy price is only 60% that of the baseline model. So it basically contributes to around 1.5 of the transmission, the final effect. Then we're going to discuss some cross-country heterogeneity. What we do in this exercise is, what if 2 countries experience the same energy price shock, but have very different characteristics? And here we highlight 2 very different countries in our data set, Germany and Spain. Spain has a very large share of energy in the CPI basket, and therefore an energy price shock transmits very immediately to consumers and to headline inflation. Germany is the opposite. Germany has a very low share of energy in the CPI, but it has a much more mature, let's say, or interconnected manufacturing structure in the economy. What this yields is Germany, after an energy price shock, the economy, like the Spanish economy inflation, peaks nearly an impact, whereas in Germany, it is much more persistent. In the beginning, it's just half of the effect, and it grows until Germany experiences even more inflation than Spain. And then lastly, implications for monetary policy. We're going to argue that input-output linkages worsen the policy trade-off, because stabilizing inflation is costlier in terms of output gap losses. Okay, so in terms of the model, I'm going to be very quick on the model. I have many backup slides in case you want me to open any of them. So in terms of the bird's-eye view of the model, we're going to allow for capital K countries. Okay, the online codes that you can use allow you to play with many dimensions there. We're going to allow for international financial markets to be incomplete, and we're going to allow for different monetary arrangements. In particular, we're going to allow for a subset of these countries to be part of a monetary union. Now, within each country, lowercase k, there are going to be capital I sectors that we're going to have national and international networks, and nominal rigidities on prices. Nominal rigidities on prices are going to be allowed to be heterogeneous across sectors and countries, and wages. Those need to be homogeneous across sectors. We don't have good data really to calibrate that object in the model. In terms of households, there's going to be it's a standard model. It's going to be a rep agent who chooses consumption, labor supply, and portfolios of international bonds. And there's going to be a portfolio adjustment cost to close the incomplete market block and stabilize the model following Smith-Groh and Uribe. In terms of the consumption basket where production networks enter, a household, K here indexes the country, so the consumption of a given country or a household in a given country is going to be a function of the consumption taken at that country from country L and sector I in that country L. And this index here is going to be a general aggregator. We're going to give different functional forms to it, but it's not important as of now. In terms of firms, the model is going to be very similar to at least the input-output structure to households. There's going to be a production function that combines labor and an index of intermediate goods. And this index of intermediate goods is going to be a function of all the sectoral intermediate goods in the economy across countries. These two objects imply that the marginal cost faced by a firm in country K and sector I is going to depend on wages and both the supplier prices that they face. And in the model, we allow both for producer currency pricing and local currency pricing. Here I'm plotting the Phillips curve for the DCP framework, where basically the inflation index in a given firm K is going to depend on the real marginal costs they face and expected inflation. On top of this, we're going to allow for price wedges. This is going to be our energy price shock. So the idea here is that the firm is going to interiorize the price wedges through the marginal costs which are going to depend on other supplier prices, and these are going to transmit internationally. In case of the monetary authority, it's fairly standard. There is a Taylor rule for the countries that have monetary autonomy, and for those that do not have monetary autonomy, there's going to be a central bank in the leader country, let's say, of the countries within the monetary union, and the remaining countries are going to peg their exchange rate to that. Lastly, market clearing, labor's market clear, goods market clear, bonds market clear. This is the definition of nominal GDP. The model does not have investment nor government spending. Okay, we've seen from that. We do have a spin-off with capital. We show that it is very important for the transmission of tariffs, not so much for energy. This is our production identity, and then real GDP is just this nominal GDP deflated by the GDP deflator. So I presented this model with some general structure. We derive also some analytical results before jumping to the fully quantitative results. First of all, we're going to assume that we're in a small open economy. That is, we only consider two countries. One of them is small, which is going to be calibrated to the euro area, and the other is the rest of the world. Then we're going to assume for this analytical results part that international markets are complete. We're going to assume that there are nominal rigidities only on prices, not on wages. This is going to simplify a lot of the derivations. And that the indices that I showed you before on the consumption aggregators and the input out in the intermediates aggregators, those are going to be Cobb-Douglas. If you do this, I promise you that you get to that Phillips curve. That is a vector, actually. So these are many, many, many Phillips curves. So let me guide you through that Phillips curve. So this is domestic inflation at the euro area. This is, again, bold letters. I hope you can see them are vectors or matrices. So this is a vector. That depends on the output gap. This is scalar. So this whole thing is a vector too. The terms of trade gaps, the price wedges, this is something that comes from Elisa Rubo's econometrica paper in 2023. We also show that they also come in this open economy framework and expected inflation. Now, in red, I don't know if you can see it very well. In red, what we're doing is we're coloring in red the parts that are new in the open framework, in the small open economy framework, compared to the closed economy framework. So this part is new. I'm going to show you later this part is greater than 0 in the sense that any movement in the output gap is larger in the open economy compared to the closed economy. And we have terms of trade gaps. I'm going to show you now in another result that in this class of models, in input-output models with international networks, the terms of trade gaps are not proportional to output. So you cannot just write them as a function of the output gap, and you cannot achieve the divine coincidence index that the Rubo gets in the closed economy. So first result, as I said before, the slope of the Phillips curve with respect to the output gap is steeper compared to the closed economy counterpart. And the rationalization, let's say, of the result is that with these production networks, if you want to increase a given increase in domestic output, let's say, requires more domestic labor once these intermediates and sectoral trade imbalances are taken into account. So this requires that agents work more, and therefore consumption rises less than output, which requires a real wage response steepening the Phillips curve. A side result that we have related to this is that in the one sector economy, the open and closed economy slopes coincide. So this is a change compared to the extension to open economy that the literature did on one sector economy, on one sector frameworks. Second result, remember the Phillips curve, this object here, this psi here? We open it up, basically. We argue that it depends on direct and indirect network propagation here. This omega here is the input-output matrix. Delta is a matrix that adjusts for the price stickiness in the economy. Then there is a CPI-induced wage response. So any change in the terms of trade is modulated by this CPI-induced wage response. And importantly, this cross-sector trade imbalance channel that is not present in one sector frameworks. And why is this? Well, we show in this proposition in the paper that the matrix governing 3, so basically the matrix in these brackets here, is hollow. It has 0 elements in the diagonal. And so basically in a one sector economy in which just have the diagonal, or in diagonal production matrices, you just don't have that object. Last result on the analytical model, and then I will jump to the quantitative results. In this economy, you can show that the output gap is proportional to a combination of the terms of trade gaps. What this means is that if you close the output gap, you do not necessarily close all sectoral terms of trade gaps. In the one sector economy, the terms of trade gaps is indeed proportional. So closing one closes the other, and stabilizing a foreign cost push shock is trivial. You just close the domestic output gap, and you just close inflation. That's very nice result. This divine coincidence result is not does not hold in our economy, and we have this proposition that no constant weight linear inflation index achieves the DCI in the open economy. So that was the theoretical part of the paper. Now that we have some idea of the theoretical framework and its implications with respect to the literature, we bring some quantitative results. So we're going to focus on energy sectors, okay, or energy price shocks. So what we're going to allow is for different elasticities of substitution in the consumption and input-output indices that I showed you before between energy and non-energy sectors. We're going to calibrate the model to 6 countries and 44 sectors within each country. The 6 countries are going to be Spain, Germany, Italy, France, and the rest of the euro area. The 6th one is going to be the rest of the world. The sector and country price frequency adjustments are going to come from this very nice Prisma project from the ECB, from Gautier et al., where they estimate price frequencies using CPI microdata. And we linearize the model by hand so that we can read all these huge, related to input-output stuff, like input-output matrices, labor shares by sectors, consumption shares, directly from the data. I have here a list of parameters, but I won't spend too much time here. I just want to show you the elasticities that we assume between energy goods and non-energy goods, so very low, and within energy goods and within non-energy goods, and the international trade elasticity. This can, of course, vary. We don't have a strong view on this. We have some robust analysis in the paper. The same elasticities with respect to firm aggregation. As you can see here, we assume that firm elasticities are more lower. The inputs are much more inelastic, and particularly within energy goods and non-energy goods. So in terms of quantitative results, I'm going to skip this. It's just the transmission, the aggregate transmission. Let me move to the more interesting ones. Here, what I just want to say is that there is a significant pass-through to core inflation, around 20% of headline, and it is far more persistent. If you see, this is headline inflation after an energy price shock of 10%. So energy prices, global energy prices increase by 10%. Headline inflation increases by 0.14%. But core inflation is far more persistent. Then the role of production networks. What we do here is we take the euro area as a whole, so we aggregate the 5 euro area countries, and we plot here, look at this picture only, the dynamics of headline inflation. This is the cumulative IRF. So you can think of this as the CPI level. The blue line is the headline inflation. The yellow line is a counterfactual in which we remove the input-output linkages. So we go back to the one-sector economy against the same energy price shock. So what we see is that initially, on impact, the effect is pretty much the same. Input-output networks are not giving you anything on impact, but they do matter a lot for the persistence of the energy price shock in the economy. So if you see the no input-output line, it flattens very quickly. You stop having inflationary effects very soon, and the blue line, the one that incorporates the input-output linkages, it's far more persistent. Here's comparing Spain and Germany. I discussed this before. I'm not going to spend a lot of time. So the idea is Germany is red, Spain is blue. What you see is Spain inflation, headline inflation, reacts much more in impact, nearly the double, because of this very large CPI weight. But because of the persistence induced by input-output linkages in Germany, it even overtakes Spain after 40 periods. Lastly, monetary implications. I have just 2 slides on this. First of all, there is a well-known result in the literature that production networks generate more monetary non-neutrality, in the sense that they flatten the Phillips curve, so any change coming from demand is going to affect by a lesser extent inflation. What we show here in the paper is that this result is also consistent with another result, another point of view in monetary policy. If you, instead of that, you consider monetary policy, instead of like shocking the economy with monetary policy shocks, you consider changing the parameter, the coefficient that goes on headline inflation, and you increase it, you basically find that production networks amplify the increase in inflation volatility from an increase in the policy, in a weaker monetary policy response. And last slide, we have some result on the sacrifice ratio, which I think goes again on the title of the conference on the trade-offs. So the output, so we measured the differential sacrifice ratio as the output gap cost per unit of inflation reduction when moving from a looking through monetary policy to a leaning against the wind monetary policy, a more aggressive one. And we find that a tighter monetary policy induces much larger output gap losses, but it doesn't contain too much inflation. So in this input-output economy, the prediction is to be a little bit more dovish. And so takeaway, sectoral heterogeneity and international input-output linkages make strict inflation targeting costlier compared to the closed and the one-sector economies here. Last, let me conclude very quickly. We provide an international multi-sector and macro model with input-output linkages that can accommodate the disaggregated nature of the recent shocks that we have witnessed. We analyze the impact and transmission of these energy price shocks, but this framework can be easily incorporated to analyze tariffs, sectoral tariffs, the effects of AI in the economy. As long as you can think of a sectoral shock, it can a very granular shock, it can be incorporated in the framework. And we show that linkages, these production linkages are important, both for transmission to core inflation and for the design of monetary policy against energy price shocks. Thank you very much.
So now we have a few minutes for questions. So are there any questions in the, yes? Oh, sorry.
Jochen Mankart from Nationalbank of Slovakia. Very nice presentation, very nice paper, and I guess you sort of expect the question. In large shocks, we've seen that the price frequency adjusts, and yesterday I think somebody showed the evidence that in particular after the energy shock, the price frequency increased a lot, and I understand you probably cannot endogenize it here, it's already complicated, but can you speculate in which direction it would go? Would it attenuate, or would some results potentially overturn?
Yeah, no, that's a great point. So Alex would be much better for that question, to answer that question. No, but we've been using it for policy purposes, let's say the model. And what we do is we calibrate these Calvo price rigidities from the Prisma project before and after the energy price increases. So you're completely right, it's completely exogenous. There is no endogeneity in the model such that after an inflation threshold, or that the Calvo parameter, let's say, is elastic to the inflation in the previous periods, whatever. But it is something that we're working on, and again, on a spin-off. The thing is, the model is already fairly complicated to solve, and we're trying to figure out a simple way to introduce this nonlinearity in a nice way.
You have a question, Nicolas? Sorry, I thought you were.
No. Sorry, no, I can't, but
maybe I have one just to. This is already pretty complicated and pretty large, but you have a very homogeneous labor sector. No?
Yeah.
And if you were to speculate a tiny bit, how much are you missing of the story by having like this homogeneous supply side on labor? Because it means that you don't have any relocation across firms when you have like these kind of shocks, and this is a bit part of the story of, for instance, COVID recession, no?
Yeah, absolutely. So if we were to, the question is, what episode do you want to study? Let's say, If you want to study COVID, I fully agree with you. Like, it is a critical assumption that you make that will determine your results. In the case of the energy price shock that we're showing here, the effects are very widespread, let's say, and you're really interested in the short run, let's say. And we didn't think it was a crucial dimension to model. At some point, we had to choose from the bundle. But I think it's a very important, and there is work on this, basically extending this aggregate labor that we have with like making frictional adjustments between sectors, or it's not so easy. Like in the model so far, people can change sector freely. In reality, probably it's very costly to move from one sector to the other, and that would induce more more employment losses, probably.
Okay, thank you. We have time for one last question. Falk?
Falk Marcellus, ECB, thanks a lot. Great presentation, wonderful model. In the beginning, you said that the model doesn't have capital right now, but you have some extensions where you look at that, and that the tariff shock actually has more implications if you consider capital as well, yes, rather than the energy shock. I'm just wondering whether how you model the energy shock, because if it's really just a pure pure pricing type of shock, then that's understandable. But I'm wondering if we're trying to model the current conflict in the Middle East, with potential destruction of capacity, I think then there's quite a bit to say about actually the potential of the economy. And then, of course, taking capital into account and also the reduction in that could potentially have some other consequence. I was just wondering whether that's something that you've looked at and what the consequences are.
Yeah, no, great point. So in terms of adding capital to the model, what we see in the paper where we study the effect of tariffs is that capital is very the macro responses when you include capital are much more front-loaded. And that's because capital is very forward-looking. And we find that if you want to analyze the short-run effect, the very, very short-run effect of the aggregate shock that we study, it is very relevant to add capital. Now, on the second point on having this, like it's true that the current episode is more related to quantities than to prices in terms of the energy. So what we do in the paper is we calibrate the elasticities such that after the energy price shock, the dynamics of output and inflation, so the relative sensibilities, match the empirical evidence on Caldara, Iacovello, and co-authors. So we do it via elasticities, not via shocks to quantities, but this is something we couldn't think about. Thank you.
Okay, so thanks all, Jose. Now, next paper is more on the financial side, and this is Nicolas from Banco de Portugal.
Okay, I'm going to stand over this side if that's okay with the mic. I guess so. You can have the benefit of having the speaker on your side for one occasion. First of all, thanks to the organisers for having me here. It's been a very nice conference and nice to get to present this work to you. So this paper is kind of going to what I think is a very fundamental question in both macro and finance, which is understanding what the determinants of interest rates that firms pay are. So I don't really need to motivate this to the room, but obviously as central bankers, we might think interest rates are the most, or at least one of the most important prices in the economy. And so it's natural to want to understand how are these determined. I'm a macroeconomist, so my kind of entry point into this is thinking about, okay, we write down macro models, and at least since the great financial crisis, we increasingly incorporate financial frictions into these models. And these are a very common kind of ingredient in macro theory now, whether you're thinking about misallocation, whether you're thinking about business cycles, whether you're thinking about monetary policy, whether you're thinking about inequality. And we have a very particular way of modeling interest rates, and we have kind of a very clear view on how they should be modeled. So in macro, we really think about interest rates as depending on two types of things. The first is the characteristics of the loan, okay? What's the maturity of the loan? What's the time at which it's issued? Because obviously the central bank is moving interest rates over time. The interest rate may also depend on the value of the loan, Is the rate flexible? Is it variable? What's the amortization structure? These kinds of things. Interest rates are naturally going to vary like that. In macro, we often write down models where conditional on those characteristics of the loan, everyone pays the same common risk-free rate. Okay. To the extent that interest rates vary in macro models, that's because there's default risk. So some firms are less likely to repay than others, and if I'm less likely to pay, I pay a higher rate to the bank as compensation for that risk. And that describes 95+% of kind of macro theory when we think about interest rates and firm financing. If we step a bit beyond that and go to the finance literature, then there's two other things that have received a lot of attention in the literature, and these have started to be incorporated into our macro work more recently. One is that the rate you pay may depend on which bank you lend from. The main reasons for that is that marginal cost could differ across banks. The other one is there could be some market power that banks have. Bank A could have a bit more market power than Bank B, and so I pay a higher rate if I go to Bank A. Finally, there's a very kind of long history of thinking about the relationships between firms and banks and how interest rates could be specific to a relationship. And the theory that kind of underlies this work, the idea is that there's information frictions because firms are somewhat opaque in terms of their operations and their ability to repay. And so when a firm has a relationship with a bank, that generates information over time and generates interest rates that are specific to the firm-bank relationship. So that's kind of how we think about interest rates in macro and finance. And this paper is going to ask a pretty simple question, which is, do these theories explain interest rates well? If I'm going to be provocative, I would say, does macro and finance theory have a good model of what interest rates look like? If the answer to that is no, then we're going to ask, what are we missing? And we're going to have a little bit to say about implications. There's much more work to do about implications, but that's for kind of the future. In terms of the types of kind of interest rates we're going to be talking about, we're going to be talking about interest rates on bank loans to firms. Why are we focusing on that? Well, one, we have the data. But second, in Europe, most firm financing comes from banks. Under the measures that we look at, it's about 85%. This was also commented on yesterday in the introductory remarks of the managing director of the IMF. So that's a fact in Europe. So if we want to think about firm financing, looking at bank loans is kind of pretty much the whole story. Okay, so let me on this slide give you a summary of what we find in the paper, and then the rest of the presentation will be some of the details. I'm going to be very brief on details today and focus on the main messages. If you want 70 pages of all the details, there's what I think is a nice paper on my website and my co-author's website. So, question one, do the existing approaches explain the data well? No. The data is extremely clear on this. The theories do not explain interest rates well. They can only account for about 32% of the variations in rates. So fully 2/3 of the variation in rates in the data are unexplained by the theories that we turn to as macroeconomists and academics in finance. Most of that variation comes from the very simple fact that there's a yield curve, interest rates vary depending on maturity, and because interest rates change over time. That's most of the 32%. Anyone who works in finance or in economics, either in the private or public sector, will kind of understand this. That's the main thing. Default risk, banks, relationships, they all have some relevance, but in the scheme of how much variation we see in the data, these are all pretty modest. I'll show you soon in the results that the relevance of default risk is surprisingly modest. So what accounts for the additional variation? Well, we do a lot of extra empirical work to understand this, and the main thing that comes out is that there's latent variation across firms that's fixed over time. Latent means we can't explain it with the observables that we see in the data, and this is an extremely rich data set. So the story that I want you to have in mind to kind of take this point away is that Alex and I are firms that look observationally equivalent in the data. We could be, say, both violin manufacturers. We have our shops on the same street in Vienna. We go to the exact same bank on the same day. He gets a better rate than I do. That difference might be a whole percentage point. That wouldn't be an extreme outcome given the variation we see in the data. Then in the future, we go forward and we get further rates, further loans. They could be from the same bank. We could change banks. He will keep getting an interest rate that's 1 percentage point, a whole 100 basis points better than me, for as long as we see it in the data. Okay. In terms of the amount of variation that we're getting from these firm fixed effects, one standard deviation of variation in that is 60 basis points. Okay, so these are large variations. So that's as far as the data takes us. So the last part of the paper is thinking about, well, where does this variation at the firm level come from? We argue that we should be thinking about this market instead of as a competitive market that's relatively frictionless. We should be thinking about it as a search market. We want you to have in mind that this is a market where there's a lot of frictions. If I'm a firm and I want a loan, I need to go and apply to a bank. It comes back with an offer. I could accept, I could negotiate, I could go to another bank, but this is a costly search process, and we know very well from search theory, both in labour markets and in markets for consumer goods, that when you have search frictions, you can have substantial price variation and equilibrium. And that's what we see in this market. We also provide evidence against a number of other potential explanations. Local bank market power, loan bundling, interactions between the finances of the individual entrepreneur than the finances of the business, unobservable demand shocks. The data is not consistent with any of those stories. In terms of implications, we do one exercise, which is what are the losses in terms of misallocation if these differences in interest rates across firms are wedges, and our estimate is that the losses are about 0.43% of GDP. There's many other macro applications we could do. We plan to do them in the future, but that's what we have for this paper. Okay, so let me give you a one-slide introduction to the data, and then we'll get into the details of the analysis. So we're using the credit registry for Portuguese, which is basically all loans from Portuguese banks to firms, and the period we're covering is 2010 to 2022. The data's coming from the new ANA credit registry. So 21 or whoever's colleagues were involved in developing this is an amazing data set. And is kind of foundational to this paper. So the top left is the interest rates that we observe in the data. This is just the raw interest rates. They range mostly from about 1% to about 6%, okay? In terms of loan values, most of the loans are between about 10,000 euros and $250,000. Our biggest loans are 2-3 million euros. There's a range of maturities. In terms of collateral, the data is interesting. It's really a binary distribution. Either loans are fully collateralized or they have no collateral. Okay, so in terms of the sources of variation in interest rates that we're going to focus on, they're going to be in 4 categories. The first kind of area that we start with is what we typically think about in macro. So the loan characteristics are going to matter. What's the maturity? What was the date on which it was issued? What's the value of it? Is it collateralized? All of these things. We control for basically everything in terms of loan characteristics that we can observe in the data. Second, we're going to evaluate the relevance of default risk. This is kind of a big part of the paper. I'm not going to go into any details today. But if you read the literature on default risk in terms of pricing loans, a beautiful thing about it is basically all of the papers imply the same pricing equation that dates back to Merton 73. So this is an equation that is very consistent across this literature, and we can take that equation directly to the data, and that's because the credit registry provides the 2 moments of the data that you need to price default risk, and that's the probability of default and loss given default. And we do a lot of work kind of taking that very carefully to the data. Once we get outside what we usually think of in macro, then we think about banks. Interest rates could vary because of market power, differences in marginal cost, and also relationship banking, which I discussed. We separate these two things in the paper and quantify the relevance of each of them. If in the interest of time today, I'm just going to lump them together. It's going to turn out that those things kind of don't account for the variation in rates that we see. And so what's the other party involved in this kind of these transactions? Well, that's firms, okay? And for firms, we're going to merge the data with balance sheet data that's going to provide us with a lot of detail on the characteristics of these firms. So we're going to use very rich controls to kind of soak up variation due to all kinds of things: labor inputs, capital inputs, productivity, volatility of productivity at the firm level, location, legal structure, many other things. There's 30 to 40 variables for the controls for the characteristics of firms, and we do various specification in terms of how they enter the regression in a functional sense. Then we also allow for these latent differences that I highlighted in the introduction as being very important. Econometrically, they're going to be firm fixed effects, or firm time fixed effects in extension. Underlying this analysis, we borrow a lot of tools from the labour literature. Our labour economist friends have been studying variations in wages for many years. So there are very kind of well-developed tools for decomposing variations in prices from that literature, and we kind of borrow those. Again, I'm not going to go into details today, but that's kind of methodologically what's underlying a lot of this, on top of the analysis we do of default risk. Okay, so this is the results of the paper summarized into one table. So we take all of the variation interest rates that we observe in the data, and then we decompose it into these four parts with some residual components left at the end, which we don't have much to say about. So we start with loan characteristics and default risk, and this is what we usually think about in macro. As a macroeconomist, I think we try to write down parsimonious models that capture the essence of what's going on in the economy and abstract from details that are not kind of important at first order. So for me, I would be comfortable if we did this analysis and we found that most of the variation in rates was coming from these sources that we think about. It turns out here it only accounts for about 23% of the variation. So a lot of that is coming from loan characteristics, which again is primarily issuance date and maturity. And there's a very small component coming from default risk. So why does default risk not matter very much for the variation interest rates? Because the banks are just not issuing risky loans. Nearly all the loans have very low probabilities of default and very low expected losses given default. And if there's not a lot of risk in the data, you can't get much variation in rates from risk, okay? So that's kind of how we usually think about rates in macro, and there's a lot of variation left on the table. If we then think about banks and relationship banking, under these baseline estimates, they account for 9% of variation. This can go up to 20% in other specifications that we have. But in all cases, it's true that rates vary across banks. Rates vary because of relationships between firms and banks. But these are kind of only a modest piece of the overall variation in rates. They're definitely not the main story. When it comes to firms' characteristics, which is the third part, we have these many observable firm characteristics that I mentioned earlier. What are the inputs of the firms? What's their productivity? What are the characteristics of their productivity processes? What industry are they in? What's their location? Many other things. The observables actually, close to a first order, I would say they're irrelevant. They only account for 4.8% of variation. It doesn't matter a lot whether you have 1,000 employees or 10 employees for what interest rate you pay, okay? It doesn't matter if you're located in Lisbon or you're located in a rural part of Portugal. That's not a major source of variation in the data. What is a major source of variation in the data, and in fact the largest source of variation in the data, are these latent fixed differences across firms. So again, to emphasize this, what you want to have in mind is two firms that look identical in the data. They go to the same bank at the same time, ask for the identical loan. One of them gets a better rate than the other, and those differences persist when they get rates, interest, loans in the future, whether they're at the same bank or whether they change banks. In terms of magnitudes, what does this mean? Again, I'll repeat this. The variation in these fixed effects in rates translates into one standard deviation of this variation is 60 basis points. Okay, 2 standard deviation is 1.2 percentage points. So again, this is a large variation, and it's coming from a source that we don't usually think about. Okay, 3 minutes. So then we think about, okay, well, where does this variation across banks come from? Why is it that two firms go to the same bank, they get very different rates, and that persists over time? We start by ruling out a number of explanations that are kind of maybe the first things you might think about as causing this. No one has studied this, so it's not like there's existing theories out there, but there are maybe some things that might be suggested by existing work. These things that we rule out are bank market power, joint pricing of multiple loans. So it may be that we don't want to look at the price of an individual loan. Maybe I'm a firm, I go to a bank and they price a collection of loans they give to me. We don't find evidence for that. It could be that an individual has, say, a mortgage for their personal house with the bank, and then they go and get financing for their firm from the same bank, and those two things interact in a way that affects rates. We don't find any evidence for that. We also estimate idiosyncratic, unobservable demand shocks using a methodology from Amiti and Weinstein. These also have virtually zero explanatory power for the variation in rates. So what do we think we should be thinking about is that it's kind of actually already documented that this is actually a search market. What happens is if you're a firm and you want a loan, you go to a bank and you provide information to the bank in order to apply for the loan, and they come back with you with an offer. This is not a market where there's posted prices for homogeneous products. Every loan is actually idiosyncratic. And so it's costly to go and search for loans, and we know in a search setting that you can have price dispersion in equilibrium. This is a very old result in economic theory. So we kind of go into some discussion of kind of within this setting, what are potential sources of variation? We highlight a few. One is there could be differences in searchability. Some of us may be more efficient at going and procuring loans than others. Some of us may have better information about what rates different banks charge, or some of us could be better at bargaining. They could be kind of sources of variation. We think about all of those as kind of economic sources of variation. But there could be non-economic sources as well. There could be effects within and across loan officers. You know, I get the generous loan officer who gives me a lower rate, or I see them in the morning and they're unhappy, they haven't had their coffee yet, they give me a high rate, I get a better rate in the afternoon. It's also possible that there are personal relationships between customers and bankers that we don't observe, or there's variation due to socio-demographic characteristics. There's evidence of all of these sources of variation in the consumer finance literature. It hasn't been studied in the case of business loans, but the variation that we see would be consistent with this existing in business loans as well. In terms of implications, I need to wrap up.
The more you extend, the less question you have.
Yeah, I'll wrap up. So a very important question is, what are the implications about this? We kind of think about there kind of being two possible cases. One is that this is a market in which there are kind of reasons why people need to search, potentially because these are idiosyncratic products. And if people do genuinely have differences in searchability, there may not be a lot that we could do about this. This could just be the equilibrium of the environment that we live in. An alternative is if the rates are due to differences across loan officers or within loan officers or for socio-demographic reasons, then that starts to look a lot more like wedges that are just going to be inefficient. Okay. We're doing more work to unpack which of those cases, which of those worlds we're in. To the extent that these are wedges, and again, that's an assumption at this stage, then in terms of doing a misallocation exercises, the losses are 0.43% of GDP. Some things we're working on in the future, building direct evidence of search in this market, using a model to kind of disentangle what is the source of variation within this search setting, thinking about additional macro implications. For example, if this is how interest rates are set, what does that mean for monetary policy transmission? We're also working on replicating our analysis for other European countries to see if this is a consistent feature across countries or only exists in some, but not all. Okay, thank you very much.
Thank you. So, any question? Michael?
Hello, Michael Reiter, IHS Vienna. Thanks for presenting these very shocking results. So let me try to make sense of it. Now, potentially, I think you try to get the relationship between firm characteristics and rates. Now, take the other way around. I mean, you mentioned maybe at the end. I mean, if this is true and if it's latent firm characteristics that explain the difference in rates, our standard theory would say this would have dramatic consequences for capital labor ratios among these firms. Unless you say maybe this is somehow mirrored by different, let's say, inefficiencies. So have you found anything like this? Because I find this interesting because a lot of stuff, let's say when you look over business cycle, we explain stuff through capital adjustment costs and this kind of opaque things. But you are looking at the long term. So capital adjustment costs should not play a role in your case. So I think this is very interesting to disentangle a number of things. Have you?
I couldn't agree more. We think this raises the question. I mean, in any model where investment is endogenous, you would expect these differences in rates to flow through to observable differences in the capital stock. When we look at the contemporaneous correlation between rates and capital, it's very low. It's not there. Which then raises the question of how do we understand that? Is it that the timing is wrong? You don't want to look at a contemporaneous correlation, you want to look at something else? Or is he missing something on our models of investment? That's also a possibility. That's a whole nother paper which we have making initial steps towards. That's as much as I can say.
So behind Michael, there was a question.
Hi, Kilian, OeNB. Thanks so much for a great presentation. I was just wondering, a very simple question. So you're looking at Portuguese banks and at a specific period, 2010 to 22, I think. So, you know, how externally valid is that? Is there any, have you looked at other data? And aggregate covers a lot of other countries. So thanks.
So we're using two comments. The first is we're using the Portuguese credit registry, which has additional details relative to the kind of common AnaCredit data set, and we use some of those additional details. So not everything we can do can necessarily be replicated, but we are working on replicating it to the extent we can. Having said that, there are two other teams of researchers, one using data, the Y14 data for the Federal Reserve System in New York, and another one using the Banco d'Italia credit registry. And we've had communications with both of those authors, and they tell us that they get results that are consistent with what we're showing. So Italy and Portugal, I would say, you could say they're pretty similar countries, just because it holds in Italy as well, maybe that doesn't extend to Austria and Denmark. It holds in the US too. And in the Y14 data, the minimum value of those loans is $1 million. So these are large loans in a very different institutional setting. So the fact that these results, to the extent that they can be replicated, hold in that data set, my conjecture at this point is this is probably quite general. But that's the facts in terms of what we have to go with.
We have time for two more questions.
Okay.
Leopold? And then behind Leopold.
Hi, Leopold Zessner, TU Wien. So I'm wondering, and that shouldn't be too hard to do. I mean, this is bank data, but I mean, in the US, corporate bond markets are much more important. And it would be really surprising if similar things came out for corporate bonds, right? I mean, there we do see a lot of time variation also in aggregate spreads and things like that, right? So have you looked into that at all?
So us, no, but there has been work in the past in the literature on corporate bonds. The residuals on corporate bonds are much lower. So my interpretation of this is that the corporate bond market is much closer to a competitive market, where the scope for these wedges is just not there, because you have many potential people bidding for the product. This again comes back to why I think search frictions is kind of key to this, because institutionally the corporate bond market is completely different to the market for firms going to banks and getting loans. And I think that reconciles why we see these different results for bank loans versus loans in the corporate bond market. And going back to, again, I think something that the IMF director said yesterday, you know, if we're thinking about productivity in Europe and the fact that we have a very small corporate bond market to the US, well, that would suggest perhaps, you know, we're not allocating our kind of capital as well, because if we are seeing the kind of wedges in or differences in rates that we see in this data. Yeah. So, yeah.
Thank you for your wonderful presentation. I have just a question regarding your final results. If I remember well, you showed us surprising results that default risk accounted for only 1.2% of variation.
Yeah.
I just wonder, your model controls lots of factors,
yeah.
so it gives credibility to these results.
Yeah.
But I cannot stop wondering whether default risk is actually hidden behind those other variables, for example,
yeah.
loan characteristics.
Yeah.
After all, banks decide how much they will loan and what collateral they want from firms based on their risks. So how did you approach this?
Yeah, so in the analysis, we add additional controls layer by layer. And so that 1.2% number is actually from the stage of the analysis where we only have loan characteristics and default risk as controls. Okay, so it's not being kind of contaminated by firm characteristics or other things. Now, your question, one aspect of your question was, you know, are the loan characteristics correlated with the default risk in a way that we may be underestimating default risk? I mean, in my view, we want to estimate the relevance of default risk conditional on those loan characteristics. So we have to control for those first, in my view, and then, you know, and then add the controls for default risk. So that's our methodology. If you have other ideas for approaching this, I'm happy to hear them, but that's kind of how we go about it.
Sounds like a great discussion for the coffee break. Yeah.
Okay.
Thank you so much, Nicolas, for the presentation. And the last presenter is Henning from the Bundesbank. That's going to present something more about product turnover on inflation rates. So, Henning, the floor is yours.
Thank you, Alex, for organizing the session and also for managing it so well. Thanks to Maria and Ernesto for organizing the conference. Now, this is joint work with Klaus Adam at the University of Mannheim. And I work at the Bundesbank, so I express my own views here and not the one of the Bundesbank or the Eurosystem. So we look into optimal monetary policy in an economy in which there is supply-side turnover. So firms come and go, and the firms that come potentially are systematically different from the firms that are in the market. And you may know that in most of the workhouse models that we use to analyze monetary policy in academia and also in policy institutions, there is kind of a pretty fundamental underlying assumption, namely that the set of products and firms in these models is constant over time. Moreover, those firms and products are usually assumed to be at a fundamental level the same amongst each other. Now, if you go away from the theories and look into the real world, you see something actually quite different. Namely, in the real world, there's a continuous process of product replacements. Products come, products go. And the same is true on the side of firms. So firms come, firms go. There's plenty of firm entry and exit. And it's actually quite a dynamic marketplace. Now, that's one thing about the question whether the firms or the products that come in are the same as those that are already there. This is also not the case if you look at the evolution of relative prices of firms or products over the lifetime of these products or firms. So as I'm going to show you in a minute, there is going to be systematic evolutions of these relative prices, and those suggests that really there's a difference between new firms and firms in the market. So given this, what we're going to do is we're going to bring those kind of two stylized facts into a relatively tractable standard New Keynesian setup and revisit in this setup optimal monetary policy. Let me start with this first empirical fact, and I think I don't really have to convince you about that one. Actually, there's substantial product and firm turnover in the economy. Now, if you look at the UK and at the product level, the rate of product substitution is 6% in the month. So it's quite a large number, and we get this by defining product turnover as a comparable or non-comparable product substitution in the micro price data that underlie the official consumer price index in the UK. If you look at the firm level, and here is a bit of evidence for the US, you get a firm exit rate of 7.5% in the year. So that is substantially lower, but nevertheless quite a bit of a number. And you could raise this a little bit if you to 10% if you include temporary firm closures. So yeah, just to give you a perspective on the amount of firm or product turnover in the economy. Now, the other stylized facts about how relative prices evolve over the lifetime of a product, and here I'm going to talk only about products. So what is the evidence that we look at here? Now, first we define the relative price of some specific product J in an expenditure category K. Now, that's just the euro price of that product J, and that euro price we're going to divide by the average price of all the products at that point in time in this expenditure category, right? Now, we follow this relative price over the life of the product and regress that price on an age trend. And we do that for all the products, so we compute a common age trend in that expenditure category. And once we have that, we have many of these age trends, and in order to show you a simple table, we aggregate all these age trends into these 10 or 12, what the UK Office of National Statistics calls divisions. And you see an interesting observation here. All these age trends are in fact negative. So this means firms come in or products come in at a relatively high price, and then this price is going to decline over the lifetime of the product. Now, that's one observation. The other is that these age trends are actually quite heterogeneous across the different categories, right? So you see in clothing and footwear an age trend of minus 10% in the year. So that's quite substantial. Now, in, say, restaurants and hotels, this is much closer to zero, right? So there's plenty of heterogeneity. But we get these age trends quite homogeneously across categories. Now, we wanted to bring those two stylized facts into a fairly standard model, and I sketched this briefly here. This is something we did in previous work, and what we do newly in this paper is to work out the optimal stabilization policy in this framework. There's a representative household that just does the standard aggregation of products. Firms face idiosyncratic exit risk, and that's this probability delta here. And when the firm is hit by this exit event, it's going to be replaced by a new firm, and that new firm is different in the sense that that firm is free to set its price optimally upon entry. Firms in the market are subject to pricing frictions. Here we're going to assume Calvo pricing frictions, but just the important point is that firms in the market have sticky prices. Now, all the firms have some markup which they want to achieve under flexible prices. That's the desired markup. And we assume that this desired markup varies with the sales subsidy, which is the same for all the firms. And that gives rise to this conventional shock in the New Keynesian Phillips curve, this markup type of shock. So that's the setting. what are the sources of productivity growth in this setting? Well, there are actually three. And to see them, let's look at the technology of the firm. So that firm J is going to produce output Y using labor L. And on the way from L to Y, there's two productivity components. One is A, and the other one is Z. So A is just what you have in the standard model. That's productivity improvements for all the firms at the same time. And that A is going to grow at this rate little a here. Now, the Z has two components. One is for firms which are already in the market and have some initial level of Z. That Z is going to grow at the rate G and gives then rise to this new productivity level of the firm. But note that the growth rate is the same for all the firms in the economy, right? So that's actually one element of making this model fairly tractable. Now, the other element of Z, that's the Q, and that's the level of productivity that firms have at the moment in which they enter the market, right? Now, the Q also evolves using this growth rate, the little q here. And of course, that's gonna determine how productive firms are at later points in time when they enter the market. Now, to see how these things really work, let's look at a little figure. And that figure assumes a steady state and that this common productivity growth is not relevant. I mean, it's not so interesting because it doesn't change relative productivity across firms. Now, you see here time, and here you see productivity. And the black line, that's the Q cohort productivity growth. And you see that early cohorts have a relatively low productivity level. Later cohorts have a high productivity level. Now, once the firm in the cohort are in the market, their productivity is going to grow at this rate G here. And what I assume here is that this rate G exceeds the rate Q, just for being specific. Now, if you look a little while at this figure, you realize that the productivity of the firms in the market is going to evolve faster than the average productivity of the economy, simply because the newly entering firms have a growth rate which is below the growth rate of the firms in the market. Now, what does this mean? This means that the relative productivity of incumbent firms is going to increase over the lifetime of those firms. And if you think about economic efficiency, this means that the relative price of those incumbent firms should fall over the lifetime of those firms, right? Because we want to have cost of production being appropriately reflected in the relative price of the firm. Now, that's exactly the fact that I showed you in the microprice data. And the question is, how can we have the relative price of the firm decline in this economy, given that we have sticky nominal prices of those firms? Well, the answer is relatively simple. We need the price level to increase, right? Because then you can keep the price of the firm constant and at the same time have the relative price of the firm fall over time. And now, of course, the question is, how can we get the price level to increase if all the firms in the market don't change their price? And the answer is the new firms. The new firms have to enter at a relatively high price. That's going to drag up the price level. That's going to happen period and period again. And that is what generates our inflation here. And interestingly, the inflation rate that is optimal and really reconciles efficiency in the economy is G over Q, the ratio of our two productivity growth rates, okay? And you see that because G is greater than Q here, we are consistent with the empirical facts, at least qualitatively. Relative prices do decline of incumbent firms. And that also implies that our optimal steady-state inflation rate is a positive one here in growth terms. So far, so good. But how does this economy respond to shocks? Now, this economy responds to shocks. In particular, the optimal inflation responds to shocks according to this simple AR1 process here. So there's a shock to G or a Q that's going to affect the optimal inflation target. And then there's a fairly persistent evolution in the optimal inflation target over time. Now, how does this work? Now, this positive experience growth shock here, now think back on the steady state mechanisms. So this positive growth shock is going to make these incumbent firms grow a little bit faster for one period, right? So their relative price should fall just for that period. How do we get this? Well, we have to raise the price level, and that is what you see here in the increase of the optimal inflation target. That's the increase in the price level in response to that shock. Now, the same mechanism works here for the Q shock, just in reverse, so that really the optimal inflation target is in this economy responds to these two types of shocks. In fact, movements in the inflation rate here, the optimal inflation target, are efficient, right? We need them because otherwise the economy is at a suboptimal level of production. Good. Now, that's one element where shocks hit the economy. The other element where shocks hit the economy is the Phillips curve. And the Phillips curve in this model with supply-side turnover is, in fact, best expressed in terms of not the inflation rate, but the inflation gap. So actual inflation minus the inflation target. And you see that once you express the Phillips curve in terms of the inflation gap, it looks pretty similar. So it depends on expected gap, it depends on the output gap, and depends on our conventional markup shock, which I introduced earlier. Now we can rewrite this Phillips curve in terms of inflation, so not the inflation gap, but inflation. And then this is really the thing that we know from the standard model, but now we get an additional innovation in this Phillips curve, that is the U star, right? So what is the U star driven by? Well, that's driven by the optimal inflation target, movements in the optimal inflation target. And of course, the U star represents an alternative source of Phillips curve innovations which are fairly persistent, right, given the persistent evolution of the target itself. So if you get a one-off shock to the target, be it G, be it Q, you get fairly persistent movements in the U star. And we know from earlier work, Smets and Wouters, that these Phillips curve innovations are important, and it's also important that they have some type of persistent structure. Now, the paper by Chari, Keogh, and McGrattan, they question the micro-foundation of the traditional way to achieve this, right, our conventional markup shock, and our U star innovation provides a little exit here, okay? Good. Now I wanted to talk about optimal monetary policy, and for this we have to talk about the objectives of the policymaker in this economy. Now that's the first equation here. This equation we talked about, that equation we talked about, I just put them here for completeness. Now what do you see for the objective of the central banker? Well, that guy cares about stabilizing the output gap with a weight which is basically the same as in the standard model. But then the guy doesn't care about inflation stabilization, but the guy cares about inflation gap stabilization, okay? And if you look at the entire problem, you see that all the interesting new policy results, they're going to come from these two shocks. And let me say this again, inflation gap stabilization, that means that as a policymaker, you have to let inflation, actual inflation, move in response to these two types of shocks, right? And for some of you, this may be a bit of a radical view, because some people think, or I mean, the textbook model suggests that all variation in inflation is inefficient. So all variation in inflation is bad. In this model, that's no longer true, right? Some variation in inflation is actually efficient. Now, how do we implement optimal policy under commitment in this economy? One way to do it, at least for all the shocks except our markup shock, is this little rule here, which pretty much looks like a Taylor rule, right? So we have the policy rate on the left-hand side, we have some intercept interest rate on the right-hand side, and then we respond somehow to inflation. But there are two important differences in this rule. The first one is that this interest rate here is not a real natural rate, but it's a nominal natural rate. So this I superscript n is defined as the real natural rate plus the expected inflation target, optimal inflation target, right? And it's clear because now the optimal inflation target does move, and the policy rate is the nominal rate, we should also have a natural nominal rate here. The other difference is that the policymaker shouldn't respond to just inflation. It should, again, we saw the objective, respond to the inflation gap, right? Now, why is the inflation target here important? Well, it's important to assess the neutral stance of monetary policy, right? So what should you do in order to keep policy neutral? And it is also important to isolate those inflation movements to which the policymaker, in fact, should react. Now, if you implement this, this type of policy rule, what you're going to get is that both the output gap and the inflation gap are going to be closed after our 3 productivity shocks and the preference shock. So that's a shock I haven't really introduced, but it's a standard preference shock to the household. And in terms of the conventional markup shock, you get this usual policy trade-off that this shock induces. Now let's look at a particular situation, namely optimal policy under one of our new shocks. And the shock I pick here is this G shock, so the experience growth shock, and it's a one-off shock. And what you see in the figures is an impulse response function to this one-off shock. And I guess the most surprising thing for us was that this shock is gonna not trigger any policy response, right? So you have a perfect look-through in this model. Policy doesn't move the feet here at all, and literally keeps the policy rate constant. Now, the reason, of course, is that the nominal natural rate doesn't move, and I say in a minute why this is. Now let's look at actual inflation. Well, actual inflation is equal to the inflation target, so the inflation gap is going to be closed here under optimal policy. So that is also the response of the actual inflation rate, and you see it's going to increase and it's going to stay high persistently. Now, why is the nominal interest rate not moving? Well, it turns out that the real natural rate is going to move. And in a model in which the policymaker is focused on stabilizing inflation, you have to move the policy rate in order to move the actual real rate, right? So natural real rate moves. It somehow is going to depend on expected inflation. If expected inflation is constant, you have to move the policy rate in order to move the actual real rate. Now, in this model, this is different. The real rate moves, the natural real rate moves, but now the optimal inflation target also moves. And those two movements are exactly offsetting such that the natural nominal interest rate doesn't move at all, and hence you get this optimal looking through policy here. Now, let's stay with this impulse response function, but let me highlight a different aspect of it, namely the fact that inflation increases, but also output increases. And that is the supply shock. But of course, that supply shock perfectly mimics a demand shock. So our G shock here is totally isomorphic to a conventional preference shock in this model. And of course, if you go and approach data that has been generated with this type of model using conventional sign restrictions to identify a demand shock, you're going to make a mistake. You're going to have in the set of identified shocks also supply shocks. Now, supply and demand shocks are going to move aggregate productivity quite differently, right? Demand shocks not going to move it in the true model, but supply shocks do move it. So if you make this identification mistake, you may also get this productivity puzzle, which people have found in the data, that productivity after identified demand shocks, aggregate productivity, in fact increases. And this model would deliver an explanation for why this is. There's just a misidentification ongoing. So let me conclude. I proposed here a New Keynesian setup with overlapping firm generations and a firm life cycle. Granted, it's all fairly stylized, but it's all also fairly tractable. And if you do the aggregation, you see that the changes relative to the standard model are pretty minor. Basically, take inflation, replace it by the inflation gap, and put a process for the optimal inflation target, and you're done. Nevertheless, even though these changes are minor, the implications for monetary policy are actually quite fundamental, right? You want to do, as an optimal policy maker, you want to look at the inflation gap, not the inflation rate. So you have to look through some of the movements in the actual inflation rate, and that is optimal policy. And also, you could, basically that's the second point. Now, to zoom out a little bit, what are broader implications of this type of setting? Well, one obvious implication is that the composition of economic growth, whether it comes from more the firms in the market, so established firms growing faster, or firms entering the market, that composition is actually important for the choice of the optimal inflation target, right? And if you're in a period of structural change where this growth composition changes, say, an age of AI, where we have a lot of productivity, potential productivity evolution from startups, or you are in a decade of declining business dynamism, right, where there's very little turnover and very little firms come in and innovate, you may want to go back to your optimal inflation target and from time to time revisit it as a central bank. Thanks.
So it's time for a few questions. Michael, and then next to you after.
Michał Brzuza-Brzezina, National Bank of Poland. Henning, great presentation. Thanks a lot. Two questions about the optimal inflation target, policy implication, etc. So first of all, how well can you observe Q and whatever that was G in real time? And second, maybe I missed something, but there was also this rho, this persistence of the target. What does it depend on? Do you know how much it is? Thanks a lot.
Thanks, Michal. So the persistence of the target is something that comes endogenously out of the model. And I skipped over it in the interest of time, but now I have the chance to talk about it. So it's basically the market share of incumbents, okay, which is something, so it's the expenditure share that goes of aggregate demand that goes to incumbents. And if you have a good firm level data set, you would be able to see it, right, at least in particular sectors. We calibrated using the empirical facts that I showed you initially, and then it's the persistence is about, and the market share, both, it's the same, right? This is about 0.95 at a quarterly frequency. And of course, you have a range of these numbers, right? But the point is the target is persistent no matter how you calibrate it. Now, how important are these two Q and these two shocks, G and Q, right? I'd love to have a precise answer. I don't have it. Yeah, I think that's probably future work, right? Look into that. We did a little bit of a computation in a previous paper, which suggests that they could be actually quite low frequency type of shocks, right? So capture low frequency movements in the actual inflation rate, which is something which also from an empirical point of view is attractive, right? We need the models to have these type of low frequency, to have an element to absorb these low frequency components. And we kind of have the hope that this is the place where this could happen. Thanks.
Sure.
Jakob Lauer, Handelsbanken. So thank you so much for a very interesting presentation. In particular, and please feel free to correct if I misunderstood it, but you mentioned that sort of, new firms basically come in at a sort of typically increased price, but at a lower growth rate. But isn't conventional wisdom typically the reverse? I mean, it's typically new firms that comes in, they sort of, they lower their prices to be able to gain market share and sort of spread out the fixed costs they have, but they also tend to grow at a faster rate. Or can you please give a little more context on how one can reconcile this? Thank you.
Oh, that's a great question. Thanks for asking it. Now, I showed you this little figure of the steady state dynamics, right? And conceptually, the world you describe is perfectly captured by this type of setting. You could take the black line and just make it steeper and steeper until it's even steeper than the blue line, and that would be exactly your world, right? Now, of course, you also immediately understand that this is going to imply different relative price dynamics. So that means that the story you have in mind is not consistent with the empirical facts I showed you. Now, maybe our theory is not rich enough to capture the true story, which I mean, this is definitely a possibility, right? It's a very simple and stylized setting. But you could also think about new firms doing actually product innovation, not necessarily process innovation, right? So firms innovate by finding the niche in the market that allows them to sell this new type of product, right? And this is one way how you could interpret the model that we actually set up here. Thanks.
I have a question. So right now you have like a very nice story that it's a productivity, idiosyncratic productivity dynamic that is going up and then relative price go down. But what if for some reason it's a markup dynamic? So initially markup are up and going down. This has a very different implication for in terms of efficiency and I guess the welfare effect at the end.
Yes.
And I'm not sure can you really distinguish those two patterns in the data?
If you have rich data, so thanks for the question, it's a great one. If you have rich data, and there is rich data for often small countries like Belgium or Denmark, right? In those rich data, I mean, what you need to have is some estimate of the markup, which usually means you need some information on marginal costs. And that is the reason why you need rich data, right? The price data at the product level, that's relatively easy, but marginal cost data is relatively difficult. Now, if you have rich data, you could measure these markups, and you see that there could be also trends in markups, but they are quantitatively, at least for these specific cases, relatively small. Now, conceptually, what these trends in markup, lifetime trends in markup would mean is once you have them, you're not going to go back to the efficient allocation, but you're going to go back to the flex price allocation, right? So you replicate the flex price, and that's all that monetary policy then would be able to do in this setting.
But then in terms of policy conclusion, you have no more efficient variation in inflation. No?
Well, you would still have the type of efficient variation that, so I guess it's not just markup trends, right? I think if at all, so actually my co-author Klaus wrote a paper on the Danish data, and they find that these markup trends are there, but they are not kind of capturing it all, right? So there's plenty, this is a relatively small share of the dynamics in age trends. So I think both of these stories, if at all, are there, and probably the productivity story is a little bit more, has a little bit more traction.
Okay, so thanks a lot, Henning. And we're gonna close the session with 15 seconds in advance, so I think we should be very proud of us. Thank you very much.
Good morning, everybody. Welcome to the last panel of our annual conference on monetary policy. No, it's heterogeneity. It was a very long title. And we stay on this policy session on topic. We heard at the academic session papers about firms' productivity dispersion and sectoral shocks, and then the policy session is about the same. And I think that after 1.5 days of talking about heterogeneities, I think it's clear that the way we learned economics, that there was one representative agent, one representative firm, and one sector is outdated. We have economies that have different sectors, different firms. And this, of course, for this session, in terms of firms, it means that we have firms with different productivity developments. They grow faster than others. And this has not only implications for the long-term growth of the economy, but also how these firms react to, especially to our monetary policy, to economic conditions, and most importantly, to economic shocks. And I think Jose Elias showed that we had all these shocks in the last years, and we have also seen that firms react very differently to these shocks. And this, of course, is also not new heterogeneity. We've always had heterogeneity, but what has changed in the last years is that we have better models. Some of them we saw this morning and yesterday. We have richer data. We have also more computer capabilities to deal with this data. So there has been a lot of advances in this area in the recent years. And so the question of this panel is, okay, given all these advancements and all this new research that is coming, what are the implications for monetary policy and for central banks? And to discuss this, I have 3 distinguished panelists who come from very different perspectives, and I think it will be an interesting discussion. So we have first Michael Reiter, who is the academic in the policy session. He has been working on these heterogeneous models for a long time and will bring the academic perspective. Then we have Jake Short from the Bank of Canada. And I think he has a very interesting perspective. First, he's not European, so he comes from not a currency union, but one country with one central bank, which we would think that makes life easier. But I think it's also interesting that we, in the euro area, we don't have a heterogeneity laboratory, which we should have, given that the euro area is very heterogeneous. But the Bank of Canada, which from my perspective should be very homogeneous, they have a heterogeneity laboratory, and Jake is the director of that. So I think that will be also a very interesting perspective. And then we have, of course, Javier, who comes from the policy institution, and from the other side of, we are central bankers. We think about monetary policy as the single monetary policy, but in the European Commission, they think about Europe in a very different way, and Javier brings that perspective. So I gave them a homework beforehand. I told them to think about these things and to prepare some opening remarks. So we will have opening remarks from each of you, and then we will open the discussion among us, but also with the audience. So Michael, the floor is yours. You have about 5 minutes.
Very much for inviting me for this panel in this very stimulating conference. I try to be short and say a few provocative things that we later on can discuss about it. I should also say I'm not working at a central bank, but the usual disclaimer applies. These are my idiosyncratic thoughts and not a position of the IHS, if there is any of this. So I'm a specialist in solving big economic models, particularly with a focus on heterogeneous agent models, but also multi-industry models and things like we were at the IHS, we were having our own heterogeneous agent new Keynesian model of the Austrian economy for small open economy for quite a while, using this for different applications. So let me say a few things. This is just, what is this? This is a funny picture. I said, take our model for Austria, small open economy model, put a standard monetary policy shock and look at the responses of 88 different industries. And then you see, oh, wow, that's the output response. And this really differs enormously across different industries. If you try to see what these are, and now I say, oh my God, I put the German version of this rather than the English one. I realized yesterday. But it's hard to interpret this, but maybe a punchline is the industries that are really reacting very strongly are very much, this is construction. And then on the other side, of course, services, public administration, and so on. But all in all, if you can't make too much sense out of it, I also find this, once you go into the details, very hard to interpret. I think my consequence for monetary policy would logically look at this, and afterwards probably ignore it. I mean, this is not something you can reasonably take into account in policy making. It would be my point, but we can discuss about this. Now, let's do something else. We are now currently using firm microdata, both what lots of people have used, namely Orbis data bank, but we also have now started using the specific Austrian data about firms from the macroeconomic database. We have this is still not so easy to use, so we are in the process of doing this. I show you only one result, which I think is one of those results that we are generating, which I think is interesting, namely an investment response to a monetary policy shock, and now identified in what is now the current fashion, namely by this high frequency shock of the Jarodzinsky-Karady. What we find out of this is, and here we show you these results for big firms which are classified along to the equity ratios. And we see that firms that have a very low equity ratio, they respond more strongly to monetary policy shock than the firm with a high equity ratio. This, one can talk a lot about this. This is interesting because simpler models of firms would more likely predict the opposite. And this is a little bit in what I want to say. We need better models of firms and of firm responses to monetary policy. I would even say our current models are pretty lousy, but that is something that I'm happy to discuss in more detail later. And this has a lot to do with how we model the response of firms to interest rate shocks. There are new ideas around. There are ideas coming from finance people, for example, who say, hey, if you look at what firms really do and what kind of hurdle rates they need for investment projects, they're around 15%, and then forget about whether an interest rate is 2% or 2.5%. They hardly care about it. This is very much debated, but this is one of many things that one can talk, and I think on this side, there is a lot to do. Summarizing a bit, I think in theory, the effects of monetary policy shocks, they're very diverse, both on the firm side, on the household side. I want to refer briefly what was said yesterday when it came to the mortgage market. I mean, I think the biggest issue here is mortgages and housing. Why? Because if you look at a young household buying a house, taking a mortgage, the net worth of this household can be very small. But then this household has a long position in a real long-term asset and takes a short position in a nominal asset, so that changes in interest rate have a huge effect on the net worth position of this household. So monetary policy, should monetary policy consider this? I think monetary policy cannot really consider this much. I think what would be more important to insulate households more from these distributional effects of monetary policy. When the first years of monetary union I spent in Spain, there was a totally crazy situation that you had a housing boom in Spain, and you had a mortgage market where people took very long mortgages with variable rates at a ridiculously low interest rate, and people were basically lured into this market, and then which fueled the mortgage, the housing boom, and brought those families into pretty precarious situation. I think nudging banks into going to a more, let's say, type of mortgage contract that insulate people more from this, I think there could be good ideas. That, I think, is something monetary policy shouldn't take it into account, given that they have to stabilize interest rates, but one would have to more like kind of a macroprudential approach to this. We were also looking, for example, at whether the low interest rates over the, before the inflation shocks, whether they had this effect of deteriorating the allocative efficiency across firms, and whether they have a higher dispersion now, a higher dispersion of marginal productivity of capital. So far, we do not really find this. We do not really find an effect, but this is ongoing work. I think there is a lot of work still to do in defining and measuring better marginal productivity of capital. And one last kind of advertisement, because people were saying, oh, we have to endogenize the price setting response of firms to the size of the shocks, like what big shocks travel fast. We have also developed IHS, we're a co-author. We have, I think, a very simple and nice way of endogenizing this by generalizing the Rothenberg pricing model. Anybody who's interested, I'm happy to discuss about this. It's also a IHS working paper. That's all for now. Thank you very much.
Thank you, Michael. So, Jack, I think we have, he's not here, no? Philip would be very interested in working with you on the regionalizing that. Jake, the floor is yours.
Okay, thank you very much for having me. As Maria pointed out, I'm the director of the Heterogeneity Laboratory at the Bank of Canada. So to give you a sense of kind of the perspective I bring, I'll let you know the capacity, what we do in that capacity. So we basically support monetary policy. So we're a research group made up of researchers who do research and analysis to support monetary policy, where we use structural models of heterogeneity, so heterogeneous agent models, and then microdata in that effort. And we bring this sort of heterogeneous angle into the monetary policy discussion. So what I'm going to try to bring to the panel discussion today is the perspective from Canada. So this is going to be unlike Europe, where we have a lot of cross-country heterogeneity in institutions or otherwise. I'm going to focus mostly on heterogeneity within a country, heterogeneity within firms, heterogeneity within households. So I'll try to bring, what we've done over the last 5 years, thinking about all the many shocks that Canada has faced, how we've looked at the data, how we've used models to kind of understand these shocks, the propagation, the transmission, and the effectiveness of monetary policy. So I'll try to bring this Canadian perspective. For the next 4 minutes, I'll try to just kind of give you an overview on sort of our take and give you a couple of examples of what we've looked at more recently. So in terms of heterogeneity, I think the central ideas are sort of understanding the type of shock, understanding where propagation matters, whether I'll show you, in terms of production networks or even among households with mortgages, who adjusts is going to matter, and these are kind of the central implications for heterogeneity and how it's going to interact with monetary policy transmission or effectiveness, or transmission of other shocks. Importantly, what we've learned in a lot of the analysis we've done is that these shocks don't pass through mechanically according to our kind of standard representative agent models. Importantly, we've done a lot of work on analyzing I/O tables in the production network in Canada, looking at responses to the recent oil price shock, looking at responses to the trade war, and as pointed out earlier in the presentation previously to this session, we find some very similar results for Canada, where the production network propagates these shocks by 2 to 3-fold. That is, the indirect effect operating through the production network can be twice as large as the direct effect of these shocks transmissioning directly to consumer prices. The other important thing we found is that, the adjustment that firms make on markups is very important. And that depends a lot on the competitive nature of that firm. And we start looking across the distribution of firms, and you see a lot of variation in their market shares, and you see a lot of variation in their response and their markups. And so understanding how a firm is responding to these shocks, how they're adjusting their markups is very important for this transmission, especially when we think about the trade war, because we have adjustments on both sides of the border. US firms are adjusting to maintain market share. Canadian firms are adjusting given the protective nature of a retaliatory tariff that Canada imposes. I think the main lesson here is that the aggregate effect is a combination of this network effect, of the reallocation that occurs, and the pricing adjustment behavior of firms. So a couple examples I want to close on of the recent work we've done is looking at the oil shock. And I think these kind of point to some issues at the monetary policy level. Canada has an interesting relationship with the oil market. Historically, demand shocks in the oil market have looked like positive terms of trade shocks. These have been positive shocks to Canada. More recently, though, that positive shock often depends on the response to investment. So what you've seen pre-2014 in Canada is oil price goes up, investment in Canada goes up, real exchange rate goes, the Canadian dollar appreciates. This looks like a positive shock to Canada. So when the conflict in the Middle East arises, a big question at the table at the Bank of Canada was, is this going to be a demand shock or is this going to be a supply shock? And so what we started to look at is, well, it turns out it depends on the state of the economy in different forms. So when we look at the level of uncertainty that's prevailing in the Canadian economy right now, given domestic policies, and given just general uncertainty globally, what we were finding is a very different response. So right now, if we think about the oil shock in Canada, when we look at the level of uncertainty and how investment responds conditional on that, we see a very different outcome. In times of low uncertainty, you get very high positive responses in investment. In times of high uncertainty, which we're currently in, we're seeing a muted response or zero response in investment. So if I'm thinking of the monetary policy, we cannot rely on that demand, the demand side to kind of save us from this current shock. So we really need to, the importance here is to really assess the origins of these shocks and the conditions that, and we can't be clouded by, just looking at averages. Past average effects are not going to be sufficient for policy. And lastly, I think I have a minute or two. The other thing we looked at when we started thinking about the response to these oil shocks was on the side of expectations. What we wanted to know here is how are expectations responding to this oil price shock? And here we have heterogeneous expectations across Canada. So we can look at households, we have data on households, firms, and professional forecasters. So we start digging through this and we do some impulse responses and we learn, okay, professional and firms have very different responses than households. Professional forecasters and firms, there's sort of a response in the short run. Their 1 year, 2 year expectations adjust kind of with the shock, but those dissipate. Their long run views are basically constant, unresponsive to the shock. But households, whether it be because of the oil, the gas prices or whatnot, respond very differently. And it actually, if you look at households' expectations, they look a little unanchored. The 5 years has a positive effect, a positive response from this oil shock. So from the perspective of the monetary policy, it's very important to know which ones matter for inflation. So if I start thinking about, do I respond to the potential de-anchoring of household expectations, or do I not? Do I think of who sets prices and how prices are set? And so we dug a little deeper, and we started to look at, okay, on the Phillips curve, which ones matter for predicting inflation? And once we looked under the hood, we see, well, household expectations matter a lot less in Canada for predicting inflation. Firms' expectations and the professional forecasters matter a lot more for that Phillips curve. And this is different than in the US. If you took Kobian and Gordinchenko's work, they kind of point to the opposite. They say, oh, if we look at consensus or forecast, that matters a lot less than households. But if you try to port that knowledge over into Canada, you would have gotten it wrong. You would have made the policy mistake of saying, okay, we need to be aggressive in response to this shock to try to stem the de-anchoring of these expectations. But so the point here is, you need to look under the hood. You need to take this information about this heterogeneity and these responses seriously in order to get that policy response correct. So I'll try to bring more of this Canadian perspective to the discussion, but I'll close on that.
Good morning, everybody. Again, thank you for inviting me to this extremely interesting session. Well, I came from the European Commission, as Maria mentioned at the beginning, so in that sense, my profile is slightly different, not that different anyway. I mean, we have seen each other in many fora. At the end of the day, we are doing a kind of similar job, but it's true that from a different angle. So obviously, I have to start by apologizing. By construction of the institutions, I am not here to give any advice on monetary policy at all. Still, the issue of sectoral dispersion and the impact on policies is something very dear in our research. Therefore, I will have the opportunity to present what we are doing and that a quite direct analogy can be taken on the conclusions we get for our policy areas compared to monetary policy. So first thing that we all know, well, the traditional euro area challenge is that we have a common currency in, I mean, but we are 27 countries. The reason I put this slide here as a synthetar was not to talk about that, and I made on purpose the example of Germany versus Italy of Spain, precisely to show that this was the classical example during the beginning of the 2000s, and that now it is getting a bit outdated. I mean, people will not say this anymore, that Germany needs a tightening, whereas Spain or Italy need loosening. Where I want to come with this is that also our own policy in the Commission is changing radically the perspective, and that sectoral issues are emerging as much more important than before. When the great crisis, when the great recession emerges in 2008, 2007, 2008, well, the leaders feel the need of having, you know, a better coordination of European policies. And so they create what we call the European semester. I know that many of you are familiar with that. And I have been working at with the European semester for all this year in different capacities. And there, what you had at the very beginning, well, the European semester or the coordination of European policies has mainly two legs. One is more prospective, which ends with the country-specific recommendations. We just published ours a couple of weeks ago, and now they have to be discussed in the Council. And this is the future, what countries have to do in the coming year according to what we think is good for them in areas like fiscal policy or the different structural policies. And it has a leg on the past or on the what we call the alert mechanism or the macroeconomic imbalances procedure, where you have to alert policymakers that an imbalance might be emerging. And so here, if we come at the very beginning of it, you had many imbalances when the crisis erupted, but probably the most famous one was the construction bubble in Spain, which had been financed mostly by German money. Are we in this situation now? I don't think so. I don't think so. So the European semester is part of it, but of course the natural evolution of the euro area has made economies, I would say, somehow more homogeneous, with a caveat also on this word homogeneous. I mean, we know it's not like that exactly, but we don't see this dispersion of economic cycles that we saw at the time. Broadly, the euro area is all going up when things are okay and going down when things are not okay. So the final conclusion of the first slide is that we are coming to the same problem, the European Commission, but a completely different angle. So you are wondering now on the monetary policy if sectors matter more, and we are going exactly from the opposite direction. We took for granted that countries were very different, that their policy was very different, and we see now that policies are quite synchronized. And so we are wondering, okay, now we have like one unique economic policy broadly everywhere. Should we start looking at sectors more than countries? And this year, for the first time in the history of the European semester, we have, for one sector, a CSR, a country-specific recommendation for all countries, and it's housing. Housing has been mentioned today by Michael and by Jacob. Housing is very different as it looked 20 years ago. At that time, yes, you had construction booms, prices growing like crazy, like in the UK, but without housing boom, other countries depressed. Now we have prices growing in almost all countries without a supply response. This has surprised us as well, because countries still are very different, but this is happening. This synchronization is all over the board, and we decided this year to propose a CSR for all countries on housing. That might be the beginning, we don't know. But that to say that, of course, this has attracted a lot of our attention, the sectoral study. So now very briefly, I will accelerate, Maria, just not to consume too many minutes. I have brought you 2 papers that we have in the last 2 years done on sectoral exposure. Of course, we are not a think tank. We try with the analysts that we have, which are not many, but we have a bunch of good analysts, to produce research. But telling you that 2 papers in the last 2 years on the same subject is a lot. So that means that is very important. The first one was done by our mirror unit, which deals more with microeconomic issues, and it was an analysis, sectoral analysis on energy. So, of course, I invite you to read it. I think it's quite interesting. And there, precisely, I mean, the conclusions are very similar to those that Jacob presented now, so that I can escape very quickly. And says that the shock is completely different depending on your position in the chain, the energy intensity, and that you saw that, for example, the companies which received the shock, which were the energy companies, were not those mostly affected. On the contrary, they did extraordinary benefits. But then the following position in the chain, energy-intense industries, for not saying households themselves, they suffered a lot. And for us, there was a lesson there. Should governments act? Many did. But is that right or wrong way? Should we have more left, Schumpeter, natural destruction happen or not? So there are many important and relevant questions for policy coming from this kind of findings. On the second paper, which is even closer to the question of the panel, it was done in my unit by my colleagues, and it's a paper I commented intensively, so I know it well. Is the analysis of inflation. So it's taking the question of monetary policy, but now not the transmission of the policy, but how inflation transmitted over the chain. And there, what you see is that you have 3 different base periods. Initially, import prices produce the shock. Okay, there my take would be that policies, including monetary policy, probably are ineffective. There's not much you can do. But then, I mean, companies which are more competitive, which can keep the profits, will suffer less. And finally, is the famous second round effects. What happened with wages is very different on rigidities, and that you can still find quite a lot of country dispersion. That was a bit my conclusion here, was not driving the analogy too far, because in this paper, I mean, why did we do this paper? We had a policy objective at the end, and it's the last part of the title, the cost competitiveness in the EU. This is the part which interests us in ECFIN more. What happens with the cost competitiveness after a shock like this? And after, after having the whole circle in which we say, yes, sectors matter a lot, we have to look at sector, the diagnosis will be much better. Then you go to the final part of the paper, and there you see that what we do at the end is comparing a benchmark from a behavioral equilibrium exchange model that we have. So aggregate variables, macro model, in which you have, the ideal, if I may so, equilibrium. And then you plug where countries have landed after the shock, and what you find is that they are broadly close to the benchmark, with exception of Estonia and a couple of them that are in the book. So it's a kind of anticlimax, because what you say is sectors matter a lot, but at the end of the road, you find that the macro aggregate figures gave the right result. So that would be to say my conclusion here, that the main point for policies, this is more for us than for the central bank, in the sense that you have your monetary policy, and in that sense, maybe there's no so much choice, although you have some choice in the tools. But we have a myriad of tools to advise to countries in fiscal and in the structural area. But at the end of the day, the diagnosis is crucial, that you do the sectoral diagnosis very carefully. But maybe we should not get obsessed now with fundamentally changing the policy advice, because at the end of the day, you see that The aggregate maybe is not the addition of the ideal enterprise, but the addition of a heterogeneous collection of enterprises. But the aggregate itself is not that different, with some exceptions. Of course, the exceptions are very important for us because we do country-specific recommendations. So another take of this kind of research is that maybe 90% of the cases you don't need to change the focus so much, but for this and that country, you have to be very careful not using the usual recipes. So the analogy I mentioned, I don't need to stop here, and then the main conclusions I have already said. So maybe I can stop here, Maria, and so we can start the debate. Thank you very much.
So thank you very much for this insight. So I guess we confirmed that there is some heterogeneity, and that firms respond differently, households respond differently. I think you skipped that, but there was one topic that was also, it depends on things like the financial position of the household or the firm. It depends on the risk exposure, also the market position. As I said before, it struck me that in Canada, and also it struck me in the Commission, because in the Eurosystem there's this big research network that is finalizing in a couple of weeks, which Jose Elias presented one of those papers. So production network is also something that everybody's doing nowadays. 5 years ago, nobody was talking about production networks. So it strikes me that we're, from very different perspectives, we're talking about the same, and we're using also the same models. But then I think the three of you said something very similar, which I think that for the Governing Council is nice to hear, that, okay, there's a lot of heterogeneity, but we shouldn't care about it. And I would really like to challenge this, because why are we doing this if at the end of the day we don't care, or we shouldn't look at this? And what I want to challenge is, okay, maybe in certain circumstances it doesn't matter. The aggregates tell us everything that we have to know. But this is exactly in the crisis or when there are shocks that we may be missing some information if we only look at aggregates. So who wants to start? Jake.
Yes, I do disagree with a little bit of that statement, which is, I will say, the aggregate is very good at informing us about what is happening. But the disaggregate and the heterogeneity is very useful on figuring out how it's happening. And the how is what's important for policy, right? I mean, I know inflation is going up. I mean, maybe we just always respond with the, tightening the monetary policy in that case. But there can be nuances. So for example, if I were to think about the COVID episode, what we were finding in Canada for markup growth and its contribution to inflation was that markup growth, when inflation was taking up, so markup growth all occurred previous to the actual rise in inflation. So what it looked like is firms were allowing their markups to increase during during the shutdowns in Canada. But then once costs picked up and inflation picked up, markups growth declined. So it contributes about 20% to the actual inflation at peak. Now, what does that tell us about monetary policy? It says, well, there's not a lot of room for trying to intervene with demand-driven policy to kind of reduce that pass-through. So again, you might say, okay, inflation's high, we need to increase, but we don't want to overextend or overreact, thinking that we're going to pull down markup growth when it's already falling. So I think that's the lesson here is that the micro side, the disaggregated view helps you understand that how, and that matters for the policy response.
Thank you. Michael?
Okay, and I would argue in the same direction. I mean, when you look at heterogeneous firms, what this tells you is about how the mechanism goes in the firm sector. And when I said we have lousy models, I mean, I think I published my first paper on these, how investment response to interest rates. It was something like 12 years ago. And then we had, oh my God, you had models, firms, according to simple models, they react super strongly to changes in the interest rates because the margin rate of the marginal productivity of capital has to be equal to the nominal rate plus depreciation rate, and then you get basically really extremely strong reactions. Then you start, oh, but then we have to put adjustment cost in there. You have capital adjustment cost. Then you start, oh, are these convex costs or non-convex? Oh, and then we have adjustment. I mean, this is all, I don't know, these are cheap tricks to somehow get impulse responses, and I think they don't really go to the where the true story is. And this is also why today I said at some point from the shocking results from Portugal, whether we could learn a little bit more about what the adjustment costs are. These, looking a bit more specifically on firms, it looks really more like it's not the rate, that the rate goes up from 2% to 2.5%. Another thing is, I mean, these are short-run rates. I mean, for the firms, long-run rates are much more important. So it's not so much an issue about 2% going up to 2.5%. It's probably more important that the availability of credit to those firms goes up, right? And those firms that have a relatively bad equity position that need the credit even more, they react then more strongly, which is pointing towards that in these episodes, which we identify as monetary policy shocks, then those firms get more access. They are most affected. I mean, lots of, I'm happier pointing out all the problems that are than any kind of solution. One of the issues that I think we have to think a bit more, now that everybody identifies monetary policy shocks as those high-frequency shocks, and you have these very strong reactions that we identify now, I wonder a little bit, what does this tell us about the effect of, not of shocks, because shocks are by definition not something that we can systematically do. I mean, we are most interested in what is the effect of standard and predictable monetary policy. And in very simple models, we think, okay, the monetary policy shock tell us also something about the mechanisms of, let's say, a Taylor rule and so on. With these somewhat unclear how to interpret types of identified shocks, and more complicated models where we take finance position, firms insure against a bad shock. I'm not totally sure what the mechanisms identified by those shocks tell us about the mechanisms of standard monetary policy. This is a question that I would like to ask to everybody working in this field.
Yeah, I was looking for one of my co-authors because if she's here, Karin. We're working on a paper that using Austrian data that looks exactly at that discussion of do we use high frequency shocks using annual data, because when you work with firm data, you're using annual data, and the high frequency shocks are high frequency shocks. So,
but they still have effects after 4 years.
Well, we actually find that if you use the shocks, you have smaller effects than if you use the interest rate. So we'll get to talk to that. Javier, what is your reaction?
No, I mean, first thing, we are talking about this topic, let's not forget, because all the big shocks that Europe has been suffering these last 7 years are supply side. So let's not forget that if we enter a new world in the future, which is more demand side shocks, of course, these issues have much less relevance. But on the one hand, I concluded by saying that, okay, at the end of the day, I see the aggregates, but I think you can also see it the other way around. We are talking about heterogeneity, and if you study all the models that we all may have done in the past, when you do a traditional model, you have a residual, and you say, okay, that's heterogeneity, whatever you call it. And now the tendency that we are all doing is the opposite. The residual is the most interesting part, because this is the one which is showing the heterogeneity, and we are trying to study it. And you mentioned the analogy that I did. I didn't develop it by lack of time, also because I think it's something pretty obvious, and that I were not teaching you anything about it. But maybe now I have an angle also to show my next point, is that what I put in my slides that I didn't mention much is, okay, we have this energy paper, we have this inflation paper. So when you have energy intensive industry, you just put those companies which are in strong financial need. When you say they are that companies which are capable to pass the price, that you put what we heard this morning, some companies are very powerful and can get very low interest rates, etc. So this is just the low interest rates make things even more difficult, both for monetary policy and for structural policies, because I think sectors are not even enough. We might be thinking that we have found a new golden mine, but saying, okay, we will start now doing country-specific recommendations for housing, for energy, etc. But no, we cannot abandon the idea of countries because, and firms, individual firms, because some of them have different negotiating power. So maybe energy has a problem in Eastern Europe, which has not in France. So I think what all this analysis that we're all doing shows is that the complexity that we are facing is simply increasing. Being the good news that probably aggregates keep on working relatively well, but being the bad news that at least we have to be aware that we don't know.
We don't know.
We don't know. I mean, this general idea, we don't know the current, the precise transmissions of policies, really how inflation really went there, because granularity for me is not enough yet in our models.
Okay.
I will say one thing that seems like a luxury good from the monetary policy perspective is the kind of like, before COVID, before the inflation spike, there was lots of work being done and lots of discussion, at least at the Bank of Canada and I think in the US, about like the unequal outcomes of monetary policy, all of this kind of inequality, how does monetary policy respond to inequality? That all, once inflation went above 3%, nobody was interested in that kind of work on heterogeneity. Rightly so, right? I mean, we have, that seems like a luxury good. So studying heterogeneity on these like kind of unequal outcomes and inequality, that in times of calmness, we can do a lot more of that work.
But wouldn't you think that when inflation is very high, these distributional effects of high inflation are even worse? And
I think people don't care about whether they just want inflation to go down. So the response, like the nuances of whether we go up by, 75 basis points or 100 basis points, it loses its appeal in the discussion.
But I would argue that, and especially this is what we saw 2022, is what you said at the beginning, inflation went up by a lot, and we were really worried. But if we had these models and have looked through those models, maybe we would have reacted. Now, I'm not saying this. You were not there, so you can say it also. We could have reacted earlier. But that was kind of also the critique, and that is also where this production network models came in the last 4 years, that we thought, okay, we reacted too late. So I think that to say that it's a luxury of calm time, I think will be a mistake. If you think, okay, it is exactly in those crisis times where you need, as you said, to dig really in the data. Yeah, sure.
I would like to stress again, it's important, those distributional effects, but you need different kind of tools rather than the standard monetary policy tool. I mean, I was stressing this, how you structure mortgage contracts. I mean, it's crazy in a situation where you are in a boom to give those very low interest rates, variable interest rates, where you can already anticipate that they go up a lot, and then the people with a very leveraged position have a hard time. So this nudging people in the banks, basically, I mean, these are private contracts, but organizing this in a way that they have mortgage contracts giving better protection, they are longer term, maybe with a possibility to repay earlier, which has an option value and things like this. Nothing comes for free, but this would insulate people better. Another thing, when it authors what comes after the oil price shocks, it has large distributional effects. But a part of this really came from the way that different kind of contracts are indexed. We were talking a lot about indexation in Austria. Then you see, for example, rents go up very relatively quickly. Then wages also go up. They also index, but they go up with a bigger lag. I mean, when one should think thoroughly about indexation, that has a few parameters. What exactly are we indexing to? I mean, should rent be indexed to wages or to PCI, whatever? What should wages be indexed to? Is it the CPI? Is Is it the GDP deflator, but also the timing? Why? It's, of course, from a distributional point of view, problematic if rents go up early and wages later. It would be better if you index that you have a longer time. I mean, these wage price spirals become smaller if indexation happens, but it happens with a bit of a time lag. And I would say, for example, about rent indexation, it is not so important how quickly this responds over the cycle. What I would not like to have, and this, I think, could be the new rule in Austria, if you have caps that then in the long run increases the gap between the wage that is automatically updated and the market wage that would prevail for these wages, right? I mean, one should think about the exact timing and stress about what has to be handled over the cycle, what has to be handled in the long run. So indexation, wage contract, that's more, I think more powerful to handle these distributional issues.
Yeah. And I would like to add that we are quickly entering a territory in which we see that also sectoral analysis and political sectoral response becomes more and more difficult, because it is true that when inflation rises above 4%, 5%, you immediately have a reaction, and a completely heterogeneous reaction all over the EU to that, mainly from fiscal policy. And so some countries decide to try to shelter a bit households or some companies in this crisis of the energy crisis, etc. Then the issue of indexation. We were discussing yesterday how different the response of the country, for example, in Belgium, is to indexation as it was 20 years ago. Belgium is a heavily indexed country, including wages, so there's almost no lag. And when this happened like 2 decades ago, it was quite painful for the cost competitiveness of the economy, because this lasted for a while, and so the overall result was that the cost competitiveness losses of Belgium were higher than their neighboring countries. But nowadays, this automatic indexation is so rooted in the mentality of the Belgian society that the correlation between actual inflation and wages is almost perfect. So you go to 10% and you go back to 2 very quickly. So all in all, it's a completely different change, and the issue of expectations that was also discussed this morning is playing a predominant role. So let's go to our topic. The policy measures have also to deal with this. So not only a heterogeneous currency union, but also sectoral diversity, more than sectoral, even firm different behavior, and on top of that, different, let's say, umbrella fiscal policies.
But what I gather from all of what you said is that it is important, their policies, but central banks should not change the way they do policies because of heterogeneity, which is, I think, a good news. Or would you challenge that? Or, for example, have you changed in the Bank of Canada the way you do policy because of these new insights? Or do we stick to monetary policy should not take care of this heterogeneous effects?
I'll say 2 things. One is, no, I mean, I think the framework doesn't change. I think, to my earlier point, it's really understanding how. The work around heterogeneity and all of that is thinking about how shocks are being transmitted, how monetary policy is being transmitted. So the second point I'll make is, I think what it changes is the trade-offs at the policy level and how much weight we put on things. So for example, I would say pre-COVID, there was a lot of weight in policy decision-making put on these unequal effects. How is monetary policy going to have effects on inequality? I should clarify what I meant by it's a luxury good is that weight is a luxury good. So as soon as inflation went above 3%, in the policy objective function, that was given 0 weight. It was like, we just have to address inflation straight on. Now, to your other point is, when you think about where the analysis on heterogeneity matters there is there you really want to do the analysis to understand the transmission of monetary policy. So you're putting all of the weight on attacking inflation, but you still need to do the work to understand how that monetary policy is going to affect the outcomes. I think one thing there was, especially with Canada and the trade war, there was suddenly questions that arose on structural transformation and how much monetary policy should play a role. And there, it's like, okay, monetary policy could have an effect on this structural transformation because it can ease financial constraints for firms that need to adjust. It works very well in helping labor market adjustments. And so the question at that time was like, should we be accommodative to help this structural transformation? And I think from our perspective, and HETLab was no, because we don't have enough information on are we going to be able to target those firms that need help, or those sectors. I mean, in theory, it could help, but it's going to be a problem if we don't have sufficient data on that. So that's my point on, okay, to understand if monetary policy can even do what we would like it to do, we need to do the deeper work. Yeah. Okay, so I'll stop there.
Okay, does anybody want to react to?
Maybe adding only one more thing. That depends a little bit what kind of instruments do we think monetary policy has. Traditionally, in a textbook model, they have only one instrument, and there is very little what you can do about it. Now, during quantitative easing, central banks were very imaginative in coming up with all other, many new tools they have, and at some point they were even, I think in the US, they were buying mortgages of certain maturity and things like that, and then you can, of course, you have more ways to, let's say, respond to what is going on in the housing market. I think I'm an outsider to this. My interpretation is that the interest in all those additional instruments has been cooling down also over the last year. So, and we are getting probably a little bit closer back to a situation where they are mostly focusing on one instrument, and then it's very limited what you can do. And again, as an outsider, I mean, how do I perceive what monetary policy people are doing? They say, oh, inflation is too high, so let's increase the rate by 25 basis points. You know, 3 months later, let's add another 25 basis points. And if we see, oh, now it's enough, then we cool it down. I mean, for this kind of thing, I don't even have to know how steep is the Phillips curve. It's a little bit, you find it out in the process. So it's how many instruments? That's what.
No, you don't say that. We need to know how steep the Phillips curve is. This is a must. The Governing Council should be aware of the steepness of the Phillips curve at every moment of the discussion.
So,
thank you.
Of course, Maria, answering this question is where my caveat applies the most. This is a very direct question on monetary policy, but still I think I can say something because it's something common to all policies, monetary, fiscal, or structural, is that learning more about the heterogeneous response of sectors and knowing better the transmission, in your case the policy, in our case of the analysis of inflation and so on, helps especially to the question when. So not so much about if increasing interest rates is necessary, but the when. And that the first paper also is very helpful when you are just importing the shock. Probably is quite ineffective, but once the shock is really internalized in the country and the transmission is really moving, that should be the ideal moment to change, and it's also fiscal subsidies or structural reforms which will be the most effective. So it's not only monetary policy that maybe is more visible because an instrument is very visible, but for the rest it's the same. I mean, we have analyzed sometimes ineffective fiscal policies because of the timing, not because of the measure itself.
Okay, thank you. So we could discuss much more, but I would like to open if there is any interest from the audience to pose questions. Celiana?
Thank you. Just a comment. Well, I think that as monetary policy makers, we have made a lot of advances in understanding heterogeneity, even if sometimes we cannot manage it. If I remember well, we were almost all conscious that when we have decided to increase interest rates after the energy shock, at the end of the day, the effects would have been stronger for high capital intensive firms and for firms with that were also hit by the energy shock, since the two things are often linked. And we were also aware of the importance of heterogeneity when the deflationary period, the disinflation, period started. Because we were conscious that service sector was the sector that was transmitting and avoiding core inflation going down. The point is that I feel that sometimes we cannot manage this heterogeneity because one of the most important things in our mind are inflation expectations. And this is what we care about at the end of the day. But I believe that, and this is just my short comment, I'm going to conclude, that heterogeneity matters especially to think about what is the right policy mix that is to inform fiscal policy. Thank you.
Thank you.
I concur.
Alex, please.
I like a bit the question that you're raising is like, it's really nice to have the data in order to understand better our aggregate outcome, but in the end, our mandate in the Euro system is an aggregate one indices on the medium round. So how do we balance a bit this question between, knowing more stuff about heterogeneity to know better what's going on with aggregate outcomes, and also avoiding a bit this mission creep of caring about the dispersion of inflation rate, the dispersion of profit rates, because this, in the end, we cannot really do much about it. So how do we not go too deep into the weed of heterogeneity and get lost a bit on what's the outcome of the policy, on being able to balance a bit this heterogeneity and this simplicity of mechanism?
Well, I mean, the restriction of what we actually know and how the data come out, I mean, this is, I would say, an extreme problem. This is even a problem for us who are modeling this, and even for modeling, for forecasting, we are not getting the relevant information in time, for example. I mean, we are already happy, let's say, talking, for example, about the Austrian case. I mean, if about 11 industries, after some while, we get some data, our applied people typically say, oh, forget about they are so faulty, the data, don't trust it at all. And I imagine, I mean, this is even for us. But we are happy if we have data with a lot of hindsight and trying to understand the economy, right? I mean, I'm not a policymaker, but I'm happy if after looking at a long time series of data, I find out what's happening. I mean, basically by this way, when I say these things are not important for policy, for fiscal policy, of course, it's very important to understand where the government spends their money and what this means for employment and production. And there are huge differences, and I think these are easier to understand. And here, look again, I mean, the policymakers are here in the room. I find, given the informational constraints, I see they should probably focus on their core things that they're always looking at. But I would still try. I mean, we want to understand as economics, we want to understand the modeling, the working of the economy. And for this, we now need all those new data and also the firm data and so on. I think the firm side is in a sense more interesting for me as the household side, and the firm data are a little bit hard to interpret, and I think the quality of them is always a little bit doubtful. And I'm happy that we have now more and more data in Austria, for example, to look at it. But I guess, given how long it takes even to get high quality data, that this is a big constraint on the policymakers. But maybe you.
Yeah.
I would say two things on this. One is a bit self-serving, because I do this work, but it's on the practical side. So I think the way I would look at it is say, our mandate is price stability, but we should hedge. And what I mean by that is we should be doing this work. We should give me a healthy budget to maintain this work, because it's going to matter in many cases. So on the practical side, I think it's a hedge. It's like you don't want to be empty-handed when it matters. So I think in that sense it is core work, but on the like theoretical side, I guess we need a lot more work on optimal monetary policy in these frameworks. That's something, and I don't just mean like estimating Taylor rule coefficients. I mean, it's really like we need a serious model of optimal monetary policy where we're taking into account these heterogeneous effects. Now that is a big research agenda, which I'll leave to my colleagues.
Okay, thank you. Are there any other questions, Johan?
John Paredes from Nationalbank of Slovakia. Jacob, I cannot stop myself of asking because you saw yesterday me talking about the Phillips curve and expectations and how to control for the different types of expectations that we can put. And I see that you have done an effort to control for that, to check households, either households or firms or professionals. So I would like to actually, what is your experience? Because I also think about the short term. What are the expectations? Are they 1 year? Are they 2 years? Are they 10 years? How do you think about these ones? So what is your take? What is the optimal one to use? How can we make the best use of or which one do we have to follow much closer than others?
So my experience is very limited in this, given that it was a recent project that I've been working on with a colleague in the HED lab. From our perspective, when we were thinking about the responses, we wanted to know kind of, in the short run, do we have persistent effects? But I think at the end of the day, we were very much concerned about the de-anchoring. So there we were taking the 5-year as the kind of what is happening to 5-year expectations. On the Phillips curve side, I mean, we're using the short run. I think that's in theory the one you should be using, because on the Phillips curve side, you're thinking about price setting behavior. And I mean, firms from my other work, I think are very forward looking, but they're not 5 years forward looking when they're thinking about a price setting. So I think on the Phillips curve, it's short run, 1 year. But in terms of thinking about de-anchoring, there's a lot of work where, yeah, it's long term. So, yeah.
Okay, I think we have time for one question. Falk?
Falk Mazelis, ECB. So just to bring it again a little bit to the current debate, inflation is high or starting to increase. People are comparing it to the 22 episode. There are many distinctions between these episodes. I was especially thinking about, Jacob, your presentation on the first order effects of inflation, second round effects being the networked economy and markups. We saw that this played a big role in the 22 episodes. So I was just wondering what your assessment, maybe the Bank of Canada assessment, is in how different this episode is now compared to then, especially when we're looking at things like the Phillips curve having steepened back then, and maybe there was a pretty high threshold for that to start, because for decades, in the euro area at least, we didn't see that happening. And maybe now that firms have learned that they can quickly raise their prices, it's still the same people working, maybe that threshold is lower. But on the other hand, there's state dependence in terms of the economy, again, in the euro area, but also globally. We don't have the reopening of the economy as back then. So, demand is much lower, which plays a big role for markups, but possibly also for wage bargaining of the employees. So maybe if you could just give your perspective on that.
So the current disruption versus the COVID-20, yeah. So I think my read there is the following. In 2022, firms were facing permanent increases in costs. So when they looked at the supply problems at that time, they really thought these were going to be permanent increases in their costs, and that's why they raised their markups essentially during that 20 to 22 period. They saw these costs are coming, we need to start raising prices now, and that was sustained. I think the current situation, and we kind of went back to that work to look at the growth in markups versus costs like in 2025. And our read of that was we didn't see the growth in markups. They remained actually negative during that time in Canada. And so our read there is, the current situation doesn't look like permanent shocks to costs. That I think the perspective from Canada, in Canada, is firms see these as the trade war, the Middle East conflict. These are temporary shocks. This wasn't a restructuring of the entire global supply chain. So I think the difference that we're finding in Canada is that we're not seeing markup growth pick up in 2025 or 2026. We're not seeing a rise in cost growth following that. So I think our read there was that firms do not expect these costs to be permanent, and therefore they're not responding in their pricing. Where in 2020, it was clear that they saw these costs going to be permanent, and they were raising markups in advance to that.
Okay. Do we have time for one question? Sophie?
Thank you very much. Sophie Wartel, University of Cambridge. It was again mentioned a bit the idea of indexation and how this actually creates feedback loops. Yesterday we had the same thing with indexation of rents in Austria and how that creates feedback loops. And when I think about different countries, so Belgium is a good example, but probably the champion of indexation is Luxembourg in Europe, where everything is indexed and it's immediate, right? So when inflation goes up over a certain threshold, the next month the entire country gets a pay raise, which is lovely to have, but obviously creates even more feedback loops there. And what I kind of learned over these 2 days is that countries differ vastly in how they link actually inflation, and by that also monetary policy decisions, with real economic outcomes. So there seems to be huge variation across Europe, how strong the links are, and how strong they are in different countries, and how immediate they are in different countries. So I actually would like to hear your opinion. What about creating maybe an indexation index across Europe to understand how strong these feedback loops actually are, because there seem to be so much heterogeneity, how much that feeds back into inflation. Thank you.
Who wants to answer that one?
Okay, I might start, and very many thanks for the remark, because indeed I mentioned Belgium for a reason and not Luxembourg. In my previous position up to last year, I was the head of the geographical unit dealing with France, Belgium, and Luxembourg. But a caveat on what you said, Luxembourg, precisely the design of the indexation is a bit lighter than in Belgium. Belgium is even more extreme, because in Luxembourg they have what they call a saut index. So when inflation is very hard, they think it's not a good thing because of second round effects. So I think if it's above 2.5%, they just wait for 6 months or something like this. So in theory, it's a lighter case than Belgium, but in reality, I made this mention on Belgium and not on Luxembourg because our traditional position in the Commission is that these indexation systems are not good for these obvious reasons of the second round effects that in the medium run really are jeopardizing strongly the cost competitiveness of the economy. But we have been surprised with this issue of Belgium, which is another lesson that we learned, that things are so complex. We know in the world of economy, you take for granted the truth, like indexation is bad, and it's not only this time. The previous round of inflation, we already said, when you see the medium term, Belgium is not the worst country. And this time was particularly clear. So the final conclusion I can give you here, no, indexation is not good. It brings about a lot of problems for the companies, for the non-shelter companies of the country to compete. We could open a whole debate now of it's not only a country, but the global imbalances that we are having now in Europe against China for the coast and the US with the innovation. And so indexation is one of the elephants in the room. But it's true that we have to take this with a pinch of salt, because in our last analysis, French inflation had more second-round effects all in all than Belgium without an indexed economy.
Okay. So you want to?
So the problem in Canada is similar but different. Is in Canadians' measure of inflation, I mean, there's rent and all part, but there's also this thing called the mortgage interest rate cost that goes into our inflation, MIC for short. And that is a huge debate about whether that should be included or not, because that's directly policy responsive, right? So it's like you increase interest rates, MIC goes up and inflation goes up. So the debate is a little different in Canada. On the indexing on the rent side, it always comes back to my point I brought up yesterday. Was all of this seems to be because it's all supply-driven market. You would think that any increases in rent would be negotiated by landlord and tenant, but it seems like whatever the max is, the landlord just goes to that. So once you know that that's the equilibrium, then indexing seems really bad.
Okay, I think the governor is getting nervous because he has to leave. So thank you very much. It was a very interesting panel, so round of applause.
Oh, thank you.
And now, so the thanks for the conference are, Martin is going to give the concluding remarks. I think we just sit here. He said something.
So I'm not nervous at all, Maria. Everything's fine. Let me bring the conference to a close. And for me, it was a very stimulating conference. I grew up academically with the representative agent, as you mentioned, and so lots of food for thought, and I hope it was the same for you. Let me just very briefly summarize the last 2 days in actually 9 reflections, not 10. We don't want to make any competition with the important books here. First, every currency area contains economies with different structures, business cycles and challenges. These differences are not only a source of vulnerability, they can also be a source of strength. A diverse economic base can make the euro area more resilient to external shocks, especially when effective risk-sharing mechanisms are in place for the economy. Second, these differences matter for the transmission of monetary policy. I think we've seen a lot of evidence for that. Yet the ECB has developed a broad set of instruments to address varying conditions across countries while maintaining a single monetary policy. So the mere existence of TPI and OMT help ensure a smooth transmission and prevent unwarranted market fragmentation. They strengthen rather than weaken the ECB's ability to deliver on its price stability mandate. So transmission, of course, has implications for heterogeneity, or heterogeneity has implications for transmission, but there is instruments to address them. Third, the experience of post-pandemic inflation surge, the post-pandemic inflation surge has reinforced an important lesson. Supply shocks are likely to remain a recurring feature. Policymakers must assess the source and persistence of such shocks, as well as their effects on inflation expectations and wage setting when deciding whether to respond forcefully or look through the temporary developments. Fourth, efficient financial regulation and supervision are essential. Financial crises leave long-lasting scars, often affecting vulnerable economies the most. Europe's macroprudential framework plays a key role in safeguarding financial stability and reducing risks of divergence. And we're coming now to the differences, and from the panel before it was clear knowing the heterogeneity is very important. It's not the same as managing the heterogeneity, so I think that's 2 different things, and sometimes you can manage heterogeneity, sometimes not as easily, and then on top of it, of course, it becomes also a challenge for communication if monetary policy addresses difficult heterogeneity issues that might not be easy to communicate to the general public. So what Michael said in terms of the most straightforward response function we have, that's sometimes also a benefit, not only a disadvantage when it comes to addressing heterogeneity. So I'm coming to the 5th point. Differences also exist within countries. Households and firms do not all react in the same way to changes in interest rates or financing conditions. Understanding these differences helps central banks improve their forecasts and make better informed decisions. 6th, monetary policy does not operate in isolation. I think that's also very important. Its effectiveness depends on a broader institutional framework, sound fiscal policies, of course, effective macroprudential measures that can be much more targeted sometimes to the differences that exist, and of course the more general issue of further progress on the banking union and the savings and investment union in Europe that are all important for strengthening resilience and supporting the smooth transition and functioning of our monetary policy and the monetary union. Seventh, Europe's labor markets have performed remarkably well, with unemployment rates near historic lows, yet important challenges remain: weak productivity growth, skill shortages, and limited labor mobility. To meet these challenges of population aging and AI, Europe must invest more in both physical and human capital. The 8th point, housing markets remain an important source of economic differences. We've discussed that in the last session as well, across countries. National factors such as land use regulation, taxation, mortgage market structure, and lending standards play a major role. Indexation, of course, also plays a major role. Because these factors are largely local in nature, national housing and macroprudential policies have a central role in promoting housing market stability and affordability, and also play a central role, of course, in research. So taking them into account for the research on the effects of monetary policy. Finally, and this is the 9th point, Europe should approach the future with greater confidence and determination. Strengthening resilience to geopolitical, energy, and supply chain shocks require deeper integration, a stronger single market, progress on the savings and investment union and on the banking union, and a serious commitment to structural reforms. Recent efforts to expand trade partnerships are an encouraging sign in this respect. Let me conclude on a note of confidence. Diversity is not a weakness of the European project. It is one of its defining characteristics, in my view. The challenge is not to eliminate differences, but to understand them, accommodate them as far as possible, and manage them effectively. A successful monetary union is not one in which all economies are the same. That's first of all impossible, second of all not desirable. It is one in which different economies can prosper together with a common framework of stability, trust, and cooperation among the countries. The discussions over the past days have brought us, hopefully, one step closer to that objective. I want to take the opportunity to sincerely thank all the speakers, all the panelists, all the participants for their valuable contributions. And of course, the teams at the OeNB and SUERF, under the leadership of Maria and Ernest, for organizing this excellent conference. Join me in giving all of them a hand, a warm hand, and thanking them for their efforts. So I hope to see all of you at the next edition of the Annual Economics Conference of the OeNB and SUERF in 2027. The dates will be announced soon, and I think that concludes the conference. But we have some more food, not food for thought, but food and drinks outside. Thanks a lot for coming.